everyone. Thanks for joining today. We are really grateful that you've chosen to share some of your busy day with us. We know that your time is valuable, and we'll honor that with what I'm confident will be an enlightening discussion with Justin. Just to remind you, our topic today is how capital market improvement have primed private lending and single-family rental for rapid growth. And my name is Tay again, and my partner Adam and I are the host of today's webinar. We represent Levine Capital Management, a real estate private equity firm founded in 2012. It was created initially to protect and build family wealth through real estate. We've expanded the same fundamental principle to benefit other investors and offer private investment opportunity. We also personally invest in. And we have Justin Parker joining us as a special guest today. Thank you, Justin. He's a vice president of Treasury at RCN Capital, direct private lender, providing short-term and hard money loans to real estate professionals. And Justin is charged with pretty much all Treasury and capital market function. He manages a wide variety of responsibilities, ranging from loan funding and sales, portfolio oversight, cash flow forecasting, credit facility relationship, and asset-based analytics. So you'll see he's remarkably well-versed in this subject, and I'm personally very excited to listen to his expertise and insights. I'm sure you'll learn a ton and get many takeaways from him tonight. Just before we jump into the agenda, I want to just remind you, everyone, that we'll have a time at the end for Q&A session, and you can put your question into the queue throughout the webinar as it comes to mind. You don't have to wait until the end to that, so please get that question in the queue. We'll make every effort to get to the questions you asked today. And if for some reason we run out of time, can get to a question you've asked, we'll definitely follow up afterward. So please ask away and your voice will be heard one way or the other. Okay, so let me just run through high-level talking points briefly with everyone here so you can sort of get the sense of where we're going with our discussion today. So it'll be a brief look at how capital markets has evolved over the last decade and how that has impacted lending practices within the industry, or not to mention the takeoff of the SFR space. And of course, we cannot miss the COVID-19 impact on the overall capital and credit market. Finally, we'll dive into the future outlook and what opportunities may be in store for real estate investor in 2021 and onward. Then after that, as I just mentioned, we'll wrap it up with Q&A, where we look forward to answering your question. Okay, with that being said, Justin, let me kick it over to you and take it away, please.
Yeah, absolutely. Good evening, everyone. Afternoon to those West Coast folk, and certainly happy to be here tonight to talk on the topic, and appreciate you gentlemen invite me on to share some at least of what knowledge I've been able to obtain. Although, as we were joking earlier, it's an ever-moving target, so it's very important to stay on top of whatever you're able to. But as they mentioned earlier, to those who don't know me, Justin Parker, I run Treasury and Capital Markets for RCN, private nationwide lender, short-term, long-term paper, and really anything from ground up to a long-term portfolio rental option. We're able to provide those services, which is a great segue into some of the things that we're going to be able to talk through tonight from a capital perspective. Run things from product generation and creation to guidelines and credit implementation, other Treasury and capital market functions that Tay alluded to this evening. So I'm excited to share some of that insight with you. And, I think the best way for us to really kick things off, guys, is to really talk through capital markets and this industry in a private lending perspective over the last 10 years, call it up until the COVID-19 pandemic. And just kind of talk about the evolution that we saw to kind of get an overview as to what options are out there and what exists and where we are today. And as Tay alluded to, please, by all means, enter questions into the chat as you have them. We'd love to answer them. And cater our conversation towards you a little bit more and be able to touch any points there. But Adam, unless you want to give a quick intro,
Sure.
I say we jump right in after that.
Yeah, so a little bit about myself. I've been involved in private lending for 10 years, let's say, before the influx of Wall Street capital. When I got involved with my father, we were lending to other investors. Then we were introduced to a local hard money lender in New Jersey through a friend, and we both participated in something called fractionalized loans. The rates were astronomical. We're talking about 4 points and 14%. Okay, those days are long gone.
Long gone.
And really what happened was, it was really interesting, is that so they were paying us a nice yield on our money. They'll pay us 1 point, then we'll make, let's say, 12%. They would make the delta, let's say, right? Whatever, And what ended up happening is it became an interest rate competitive environment where they wanted to basically chop us down, the investors, because they had to lend out for less, which means they had to pay us investors less. And what ended up happening was I was intrigued. I studied a lot about the markets, the capital markets, what was going on. And I ended up forming a relationship with two of my partners who are local flippers in New Jersey, RCAD Group. We created RCN Capital, which has been in business for 3 years as a private hard money lender. And we leverage Wall Street capital, right? And there's a lot of liquidity in this market. It is just it's very interesting, and I'm just so thrilled to have someone on here like Justin that has the inside knowledge that even myself or Tay don't even have. We don't sit at that side of the table, and I'm just excited just to hear what the knowledge. So anyway, thank you everybody for joining us, and let's get to it. So let's talk about the kickoff, like the start of when private lending, why did private lending, what was the reason for it coming, right?
Yeah, no, absolutely. So it's, the best way to start is to go back to the crisis in 08, 09, right? And after everything fell apart, and certainly, everybody that is on this call at least knows what the crisis was, if not lived through it to some degree, understands the level of impact that had to the U.S. economy and the housing industry as a whole. But lo and behold, stemming from this was this hard money lending opportunity that existed in the space. And that's really, when you look back, how private lending began. And when you look at where it is today, and as we go through the evolution, it's pretty remarkable to think about the level of development that's occurred over the last 10 years. This is a relatively unseasoned industry when you compare it to a lot of the other markets that exist in the world. Yet we've had so much experience in a 10-year period regarding evolution and the introduction of Wall Street money that we've created this sophisticated lending product that is just a household understanding nowadays compared to maybe what it was a while back. But to your point, I think it's best to go back to the beginning and really understand how it's become about, right? And if you look back to 2010, and that was when RCN started, and that was really the starting point of where things are today, there was still a great demand out there for distressed housing and being able to find ways to get people the money that they needed in order to acquire assets and continue to invest in real estate to some degree, on a residential component, on a commercial component. We needed an opportunity or something that existed in the space to allow this industry to formulate and allow people to invest in housing. As you can imagine, in 2010, most banks didn't want to touch anything because they were still trying to recover from the economic downturn that occurred, right? So up and came hard money lending. And the idea was, I know a guy who knows a guy. That's kind of the way the mentality was back then, is I know a guy who knows a guy who's got some money and they can help you invest and build your real estate. And oh, by the way, if you don't pay it back, we're going to hit you in the knee with a lead pipe, right? I mean, that was kind of the mentality that occurred in those early days. But what happened was there was a small snowball that was really starting to build on a year in and year out basis that started to be the cornerstone of where the market was. And when you look back to, those early days, and I consider those early days to really be, call it 2010 to 2013 to 2014 range, it was really truly just, bridge short-term debt that people were providing to acquire a property, or maybe to extend maturity on a particular deal that they were working on, or build out their portfolio, or whatever it might be. And it was a very, Adam made a great point. It was hey, it's going to be 14% and 4 points, and that's what it's going to cost to get our money. And at the time, you're going to take it because that's the only option you have. And a lot of that stuff was true hard money, in that it was a very asset-based, quality underwrite, if you will. And that's kind of the cornerstone of how this industry has become about. Instead of looking at bank statements, instead of looking at somebody's level of income and so on and so forth, you're looking at the property, you're looking at the value, you're looking at what you're getting yourself into. And back then the idea was, okay, if there's some sort of equity built in this property based on the LTV that I'm lending, we got ourselves a good opportunity to have a money maker of a deal right here. Whether it performs or defaults, we've got a chance to make money. And that's kind of how the industry came about. And when you think about it from a capital perspective, it truly was, I know a guy who knows a guy. A lot of people that had a great deal of money is effectively where the money was coming from. It was privately funded. People were writing loans, and they were keeping those loans on their balance sheet or on their books and doing whatever they could to help them perform. But that was really it. If you look at somebody like an RCN, for example, we're privately owned by an individual who had made a lot of money via a different business alternative. And he had the wherewithal to put the money into the space. And that's how the space came about. It wasn't a bank coming in and setting the tone or whatever it might be. It was truly the I know a guy that's got some money mentality that kicked things off. And as time progressed, on a high level, we'll talk through the evolution of the capital, and then we'll get into the nitty gritty. But what we've seen over the years is a very interesting dynamic, to where if you look at the 2010 to 2013, 2014 timeframe, it was the lending your own money model. It's our money, we're lending it, 100% of the money is ours, and that's how we're building it. Around the 2014, 2013 to call it 2015-ish range, we started to see some local banks catch on. Not the major banking institutions like the Wells Fargos or the Morgan Stanleys or some of those large institutions in the world, but true local banks that were looking for yield is what they were looking for. And at the time, as the industry had started to recover from this, downturn from the crisis of 08-09, I think people continued to start to understand that at the end of the day, U.S. housing is a secure investment. It's not going anywhere. We understand how to value it properly. We understand what the purpose of it is, and we understand that it's not going away anytime soon. So what we started to see were some local banking institutions that were looking to find different ways to invest their money start to provide debt. And that was a big turning point in the industry, to where we went from lending somebody's money to now starting the path to be able to scale this business. And if you think about things from a capital perspective, from a high level, you have to have some sort of efficiency with your monies. And if you're lending your own money, if I'm lending $100,000 and I'm not doing anything with my $100,000, I'm out $100,000 until that loan pays back. So how do I continue to reinvest if all my money's soaked up in one deal? And when warehouse funding and banks started to come on board, this was a great turning point in the industry, because what you had were banks that were coming in, and at the time they were giving you some sort of advance rate of 60, 65%, and they were charging you some interest rate in the 6 to 7% range, maybe even higher in certain cases. But what you were getting was that $100,000 loan that I needed to lend somebody. Now I had a bank coming in behind me and returning me $65,000 so I could go and continue to reinvest. And that's really where we start to develop this mentality of scale. And that was really what allowed a lot of this business model to take off. So that was kind of step one, right? Was you have banks that started to come in, approach the business, and throw some money in, which gave it a little bit of structure. And by that, banks come in, they have requirements that they want to see. Maybe they want to see appraisals that are done in a certain manner. Maybe they want to see certain diligence items or certain parameters involved. And as more and more banks started to jump into the mix, what you start to see is a parameter start to be set around the industry, where it may have been, RCN throwing money out in any random fashion that they felt made sense for the asset. Now there was a construct to it. Now we had to kind of remain within a certain realm of understanding for our lending practices. So as time progresses, that's kind of step one to the scale. And then we start to see some large institutions, some hedge funds, some private equity start to throw money into the space to create some lenders, right? I mean, that was the idea was, hey, there's an opportunity here that we might be missing. We believe in this asset class. Let's go invest some money into it. Let's put a lot of money behind it. And Adam mentioned Blackstone as one earlier. They were one of the pioneers that jumped in the space alongside a handful of others in there. But we had some really large financial institutions that saw an opportunity and they started to invest money in it. Now, it was at the time invested behind a lender, but nevertheless, that level of validity, if you will, where you had a Wall Street-based name attached to this space changed everything. What you started to see is this snowball, tidal wave effect of, if this person's doing it, why aren't we doing it? And that's the conversation that started to bubble up in a lot of different arenas regarding this private lending space. And at the time, again, it was still very catered towards, that short duration, bridge, fix and flip style of loan product. But what you started to see now was a little bit of evolution and a little bit of product introductions that people saw as an opportunity. A great example being this idea of a portfolio rental product where people were going and looking to go buy large, many property portfolios and hold them as rental. And at the time, that was a huge opportunity in that, 2014 to 2016 timeframe where, a Blackstone of the world, you had the Colonies of the world, you had some of these big institutions that saw, hey, this is something big. And by the way, there's a lot of yield attached to it. And Adam said it best, and we'll kind of talk through it tonight a little bit more further down the road. But the way you kind of see the progression of rates over time, even at that point, rates had come down a hair. We're still talking 10 to 12%. We're still talking very yieldy amounts of money that are backed by a piece of collateral that people still believe in and really, truly love. So you have that begin, and that's really a launching point as well to have more entrants come into the space. And as Adam and Tay and I were talking before the call tonight, more competition is great because you create a marketplace and you start to create, I don't like to say a bidding war because I don't think that's the right way to say it, but you start to see a larger set of volume that you can start to really construct the parameters of an industry around. I love comparing it to just a stock. A lot of people that are on the broadcast tonight understand, volatility in stocks. And if you have a stock that trades twice a day, the price point that it trades at is going to be incredibly volatile. And it's hard to really understand what's going on with that stock. The same can be said about our industry and many other things, quite frankly. As we see more volume, as we see more production, as we see more, performance metrics and things that are starting to create a full-scale picture of the products that are being offered and ultimately what it entails, now you start to have something that people can rely on a little bit. And I think COVID is a great example of where we lose that reliance, and we'll talk about it later tonight. But now you start to see a little bit of a marketplace forming to where we have a pretty defined area of rates and leverages and product types and parameters. And that's exciting at that point in time because now we're really talking about something that could really be big, right? It's not just a little niche product on the side. Now we're talking about a true marketplace, a true industry that can build itself up over time. And, as we started to see that a little bit more, what you saw were some of these investors that were putting money that was going to effectively lending on these loans. Around 2016, you started to see a dynamic shift to where some of these investors and some of these pools of money saw an opportunity to buy these loans and not be a lender. And you went from lending your own money to having a bank that might finance your collateral that you're originating, to investors investing behind to be the equity behind some of these lenders, to now some really wide scale Wall Street money wanting to come in and purchase the paper. I think Torak is a great example of one of the pioneers that jumped into the space as an aggregator. They came in, I believe, in 2016, 2017, and what they saw was they were privately backed by a very large firm, and KKR, correct, a Wall Street-based firm which had a huge notoriety to it. And they came in and they said, we see an opportunity to start purchasing paper. So now you've got this interesting dynamic of where you have loans that you can either fully fund with your own money, you can put some leverage behind it to only put up some of your money, or you can sell the whole thing for a certain interest rate or a certain yield and sell it for 100% of your money and have that $100,000 to reinvest. Now, there are different scales to this, of course. If I'm using my own money, I'm making that full 14%. If I'm warehousing it, there's a blended rate because I've got to pay the bank. And of course, if I sell it, there's a rate that I've got to pay to the investor, which minimizes my spread. But what it allows me to do is take something that, I love to give this example to new entrants to my team at the company, which is if I've given $1 million and I want to do a bunch of business, if I do a $750,000 loan tomorrow, I'm down to $250,000 to use until that 750, hopefully, fingers crossed, pays off. So what do you do to make the most of the money you're given? You got to find a good way to manage your capital via all these different strategies, right? And oh, by the way, during all this, what you have is some of these larger lenders that are backed by Wall Street funds are now starting to try to securitize the paper. And that's not only from a lender perspective, but that's an end goal for the aggregators at this point in time in the life cycle of really the industry. And that's a completely different exit strategy that we can start taking and looking into, to where we can access those proceeds in a public or privately traded marketplace that's well-defined, well-renowned. Everybody's familiar with the ABS market. And if you can put a QSIP behind this paper, and you can start driving multiple investors to invest in the bonds that back the securitizations, now we're really talking about something interesting, right? Now you're talking about multiple investors that can participate in a multitude of ways, whether it be buying the paper, whether it be investing in the securitization, and whether it be putting money behind a lender. And now you've got this multitude of options of where money's coming from. And as a lender, the three of us sitting here, that's amazing, right? Now we're really cooking, right? I mean, this is exciting stuff, but it starts to create this scalable marketplace. And I go back to the word scalable so often because I think it's important with securitizations. As more securitizations start to print, you get a more normalized price point. You understand what investors are paying for the paper. So I, as a lender, know exactly what I have to price the paper at in order to make sure I'm making money, but also making sure that my customers are making money. You start to understand the parameters of, what these loans look like. And then you start to see more introductions of new product lines, right? I mean, this all starts with a short duration, hard money loan. And as this continued inflow of capital from Wall Street continues, you start to see, rehab loans. You start to see these portfolio rental loans. You start to see single asset rental loans, which is going to be a big topic of conversation tonight. And you start to see this multitude of, okay, we've gone from single family housing to 2 to 4 housing to multifamily and mixed use and commercial housing and so on and so forth. And all of this inflow of capital from Wall Street and all the different strategies that start to formulate over time throughout this 10-year period is the driving force of where things are, right? I mean, it's such a driving force to how, a lender can formulate the money that they're lending to not only understand, how to best utilize it, but understand how to best service the customer, right? And that's a huge part of this is we see the opportunity, and this is an ever evolving marketplace, right? And when you look at the U.S. housing market as a whole, and particularly the business purpose investment real estate market, it's a constantly moving target. There's no other way around it, right? I mean, customers are always looking for the latest and greatest. They always want to have the best possible terms available, the best flexibility available. And as a lender, we want to give that to them. And, as time progresses, we also need to be able to understand how to scale, how to be able to service those loans, how to be able to properly, construct a business model that allows success, right? I'm no good to somebody if I give them money and I'm gone the next day. I need to be there for them throughout the life of the loan and be a partner to them to make sure that loan can reach its successful point, which is important to all of us here on the panel tonight or the webinar tonight. And it's the inflow of capital is what allows that to happen, because as time progresses and you look to, we're lending our own money, we're not relying on anybody else. The only lessons we're learning are the lessons we learn, right? That's plain and simple. As a bank comes on board, that bank's might not only giving me money, but Adam money and somebody else money and somebody else money. And now all of a sudden we've got a little bit more of a, partner we can lean on to understand, okay, what's going on out there? Who's doing what? What do we need to watch out for? How do we operate best and in the most secure manner, right? Because we do want to write performing loans. And now you get a little bit more of a variety of answers based on what others are doing. And then again, as Wall Street comes in, and when Wall Street comes in, they're not just throwing money around to throw it around, right? When a Wall Street, backed piece of money comes in, they have parameters that they want set. They have expectations on what they want to see. They want certain performance metrics to be hit while staying within the confines of, deal parameters that allow them to execute their exit strategy the way they want. If you think about all the options of a loan, a lender might be balance sheeting a loan, then they might be leveraging it with a bank, then they might be selling it to somebody, or they might be securitizing that paper. That end buyer is doing something with the loan. They're balance sheeting it, they're leveraging it, they're securitizing it, they might be selling it to somebody else. So there's this very interesting, life of a loan that can occur. And when you're thinking about all the different dynamics, and it's one of the exciting things I think we get to discuss tonight, is you got to not only think about what it takes to make sure that we're doing things the right way, to service the industry, to be able to give products that are successful and products that really meet the needs of a real estate investor. But you also got to think at the same time, now I've got all these capital options behind me. What do they want to see? How can we all work together to make sure we're achieving the same goal and really putting some controls around the marketplace? And what this evolution over the years did was take something that was, Justin Parker saying, this looks like a good deal, let's try to price it at this point and see if it works, to a level of we have so much information at our hands now and at our fingertips, because all of this money that's inflowed into the space has allowed so many business models to scale to where they can create so much more volume and so much more opportunity for the real estate investor community, that we have a surplus of data points that we can work on to really understand what works, what doesn't, what parameters we like to see versus what we don't. And it's allowed the construct of where things are today from an overall practice. So, Adam, I might stop and let you speak for a second here. I know it's long-winded, but I think it's good to kind of have that overarching overview just of the development over a 10-year period and kind of what that looks like.
No, this is great. So going back to, let's talk about how before the Wall Street money, then the Wall Street came in. But from my understanding, it's really the securitizations that's really compressing the rates, right?
Yeah, it helps. I mean, when you think about a securitization, and depending on the loan product, securitization could differ on a number of different fronts. But when we talk about rates and what, as a lender, we're able to offer, when you look at your own balance sheet or your own equity, there's usually a high price tag associated with it. And when you look back to the hard money days, those rates ranged around 14%, right? I mean, because there wasn't any really competition, so you could charge whatever you wanted. And that was the right middle ground to where you felt you were getting the money you deserved, and it still worked for the borrower at the time. And as more Wall Street money is poured in this, I'll go back to the banks. As banks came into the space, their cost of financing was, much less, right? They might be only charging a 6% interest rate at the time. And as time's progressed, that rate's drastically down, especially as LIBOR and some of these market benchmarks have declined. Now you're seeing interest rates from these banks financing at levels of, 2s to 4%, honestly. I mean, it's pretty wild, but at the time it was 6%. But what that allowed me to do, or allowed a lender to do, is reset their price point. So instead of me lending all my money and not having a high price tag associated, now that I'm using somebody else's money, my blended cost has reduced, right? It may be reduced from, I don't know, let's say 10% is my cost of equity, just for the sake of the example. Now it went from 100% of a 10% coupon to, 30% of that is a 10% yield. And I've got the bank charging 6% on the rest. So my number just came down from 10% to somewhere in the, call it 6 to 8% range. So now I can start pricing loans in a 10 to 12% coupon range. Or maybe bring down from 14, another 2% or something, because now my cost of capital is a little bit cheaper. And I have a little bit of optionality and ability to, scale that rate down. And of course, competition helps drive this down. But that's a great starting point to understand how the rates took their first decline. Because when these banks came in, they had a cost of financing that was low, and it allowed people to better utilize their capital, which means it had a better capital cost to it. And it allowed them to reduce the rates to the marketplace. Then you take into account really the Wall Street money, as we like to call it here tonight, on both spectrums, right? On the securitization side and on just the whole loan purchase side. When you look at the securitization, it's a multitude of investors investing in a deal that are structured bonds with rating agencies reviewing the collateral and assigning a Q set to where that paper can be traded. When that occurs, now you have a different dynamic to where you have something that has a construct to it, right? I mean, it is a documented construct that has to be abided by, and an investor likes to invest in something that they know is black and white, right? I mean, they like to understand what they're investing in and don't like to take that risk. And you get a little bit of that with securitization, plus you get the ability to trade that paper, which is a great thing to have when looking at price points. And we'll talk about during COVID, because it was a big piece of the private lending pandemic. But now you've got these securitizations, which are aggregating so much collateral and allowing multiple investors to invest. And when multiple investors are investing in a deal, if you think about just a basic securitization, maybe it's an auto deal, which is how I started my career, which was in the auto securitization sector, or maybe it's just a traditional residential mortgage. When you have multiple investors investing and wanting to get into bonds, usually they're not investing, just enough to get to what you're looking for as a lender. You might have a $100 million bond, and you've got investors that are bidding $50 million, $25 million, $75 million bids. And what you're trying to do is when you have a number of investors investing in something, and let's say I've got a $100 million bond and I've got $400 million worth of investments on the table, I get to drive my price down a little bit because I've got a bidding war for people that want my paper and want this product. So if I went out and said, hey, I want to securitize this at, let's say, 5% for the sake of the example, and now I've got a bunch of investors that want to invest in this deal at 5% and it's oversubscribed with the level of interest, maybe I can take that down to 4.75. Maybe I can take that down to 4.5. Who knows? And of course, over the years, this benchmark has declined, right? So this is really just an example. But as more Wall Street investors and more funds and more institutions wanted to get into these deals, that's what happened. You had people that were wanting to invest and loved the collateral and got behind it and saw that first deal work and wanted to get into the second. And it just slowly drives down the price so long as that collateral is performing. And it's a great piece of, an investment for somebody to look through. And then when you see that aspect of it, you've got to think about the dynamics of the securitization. A securitization is going to require a great amount of volume. It's not like somebody that's originating $1 million, $2, $3 million a month can go securitize. When you're doing a securitization, you need that thing to be hundreds of millions of dollars. That's the reality. And you have to be able to have the continuous volume as a lender to produce that. So while the securitization market was driving down the price point for the big lenders that were in the space, and there was only a handful that could really accommodate that task. Other smaller lenders didn't have that opportunity. So they were still leaning on the banks to get that stuff done because that was their only option. If you're doing $5 million a month, you're not going to be able to do a securitization. So that's when the opportunity rose for, investors and Wall Street money to enter the space on a whole loan purchase perspective. And that goes back to the TORAC piece of this business, right? So if I'm a business model that, at the time it was B2R, now it's Finance of America, that's who Blackstone had backed. When you look at what they had a Blackstone that effectively has infinite money, in my opinion, right? I mean, they have more money than many firms in the world do. So they had the ability to scale that, but not everybody has that luxury of having that money to scale something quickly. So you've got to come up with different alternatives and capital strategies. So the large lenders that had the pools of money behind them to be able to do that, that's how they were scaling down their cost of capital, was via securitization. The ones that couldn't at the time, and RCN would be one of those that was not able to securitize based on volume, you started to see an opportunity, and kudos to TORAC for being kind of the pioneer of this, in my opinion, of being able to come in and see the opportunity backed by KKR. They came in and said, let's buy paper. Let's buy paper from the guys that can't go out and securitize. And what we'll do is we'll aggregate all this paper and we'll securitize it ourselves and do it our way. And what we'll do is we have the benchmark of where these securitizations are priced in the marketplace. So what we need to do is we need to figure out our cost of capital. We'll buy loans at a predetermined price, and it'll be an option that's not as great as securitizing it by yourself, but it's an option for those that can't securitize to help scale their business. And what you saw was this massive opportunity for lenders of all shapes and sizes throughout the nation be able to start deploying their funds and scale their businesses in a fashion that allowed, this industry to branch across the entire nation in a multitude of varieties. And they themselves were not lending 1 to 2 loans and then they were out of money to keep lending. Rather, they could start to build their business based on recycling this capital and selling it to a TORAC or some of the other aggregators that have since entered the space and scale their business that way. So their prices were at a little bit of a higher rate. But to your point, that rate is really driven by the end securitization that a lot of this is being done. And then if you fast forward to the end, which is right before we were going into the pandemic, you had securitizations, you had aggregators that were looking for collateral. And if you think about where this country was from an economical perspective, interest rates were so low, treasuries were so low. And if you're an investor, what do you want to invest your money in? Do you want to invest your money in something that's not going to yield anything? Or do you want to invest your money in something that's backed by, in my opinion, the most secure asset in the world? And what you started to see was now we've got a little bit of a different variety to where, there were pools of money that were coming in to aggregate loans. Now you're starting to see insurance companies come in and buy loans because they need to place their money somehow, some way. And that's a great way to yield their money. You see some hedge funds and some private equity companies and a multitude of different firms starting to enter the space that normally would maybe invest in a securitization, but normally speaking, they wouldn't want to have any sort of, I'm working with this lender on buying their loans, right? I mean, they like the construct of something secure like a securitization. And now these guys are starting to move away and they want to invest their money in the space and in this collateral because it's such a yielding asset to them. And what that does is if you think about insurance money and the cost of capital associated with that and what they're trying to achieve, now they're coming in and driving rates down. And from a lender's perspective, the culmination of all these different things, different loan buyers coming in, insurance funds coming in, the securitization market stabilizing and driving funds down, my cost of capital continues to decrease and my cost of financing continues to decrease. And what you see is we were at 14%. Now we're at 10%. Now we're at 8%. Now we're pricing loans at 6%, just as this continued down or, concession of price point drives the market down. And healthy competition is part 2 of that, right? And that's any marketplace. Competition is good for a good marketplace, right? I mean, that's kind of what you get taught in economics 101. And when you have competition driving those rates down, it's a very unique situation where, now you're going to these guys and saying, hey, I need for our capital to be a little bit cheaper so I can still service the marketplace and service my customer in a way that helps drive business and allows them to have the flexibility to grow their business.
And that's the same factor with widening the credit boxes as well, right? Because I see a lot of lenders. I mean, they may not even be in business anymore. Some of them, they were really stretching the envelope.
Yeah, and that's I mean, that's what it comes down to, right? Is it's a healthy marketplace, but you've got to be smart about it too. What you saw was people were looking for any way to get a leg up on the next guy, and that doesn't always result in the best collateral, right? I mean, that doesn't always result in the best loan. So I think that there's a healthy balance, and we can certainly talk on this a little bit. I want to be mindful of our agenda and the time we have tonight, but there's certainly a healthy balance that has to be done there to where this credit box was widening, leverages were skyrocketing, FICO levels were drastically reducing. The amount of collateral that was available that you could lend on was drastically increasing. And it's important to be able to scale it. It's important to be able to have that construct that allows you to grow your business and try to service in any way possible. Competition is going to twist your arm a little bit in terms of what you got to do from some of those perspectives. But at the end of the day, and I think it's one of the good things that we do as a company, and I think it's important in the industry, is when you write that loan, it's so important to consider in the back of your head, is this loan going to pay off? Is this loan going to perform? Because that is what has that level of understanding is what drives success in the industry, right? If people are just writing loans because they can do them and because they can sell them, then what you start to have is a bunch of loans stop performing. And all of a sudden, these people that are investing in our space no longer want to invest in our space. So we regress back to part one and have to build it back up. Having the sheer amount of volume that's been in the space, it's allowed a lot of people to learn lessons. I know from our perspective, we've learned lessons the hard way over the years. Without doubt, nobody's perfect. Some loans just go bad. It's just the reality of the industry. But from your perspective, it's important to do what you can to make sure they don't go bad. Take the data that we have over the years to be able to understand, what goes bad and what doesn't. Layer that into your procedures and your processes to where, as private lenders, we can offer that flexibility to get an investment real estate deal done. But at the same time, we're being mindful of the credit aspect of it and knowing that it will perform. And that comes with, things that people might not expect, right? I mean, I think one of the unique things about our industry is, you see people lending on 500 FICO scores, 600 FICO scores. And that doesn't necessarily mean it's a bad deal. Those deals might be good. Maybe somebody just had a rough patch and they're trying to rebuild their credit. Maybe somebody had a credit card that it was a store card that they didn't realize was delinquent and their credit's taking a huge hit for it. They might bring a project that makes a ton of sense. The assets there, they've done this before. They're able to show that this is a good, feasible deal. And that's what brings this industry the uniqueness that it does, is we can look at that and say, yeah, you're right. I see your FICO score, but the story you're telling me and what I see in front of me is correct. This is a great asset. This is a great neighborhood. This is a great project. This is some black and white approach that a traditional agency, mortgage or your traditional local bank can't do. They just simply don't have the capability of doing it. And that comes with experience. And that comes with capital coming in as well and allowing the industry to scale, which gives everybody this massive pool of performance data.
Companies, pension funds, the big institutional investors, because this is not the first rodeo. This happened. Sure. It's a proven model.
That's right.
Now they're jumping in head first. And
when people start to see consistency, steady volume, stability, they're able to see the performance of assets, which securitizations allow for that tracking to occur. The aggregation of loans on a large scale allow that tracking to occur. You start to be able to notice trends, be able to notice opportunities as well, right? I mean, not only can you see areas that might be failing, but you can see areas that you might need to double down on and grow the business. Or maybe we see, the unique thing about this industry and investment real estate, and we can talk about, when we look at the future outlook of 2021, we can talk about housing fundamentals and the overall industry itself. But, we start to see this fluctuation of what people are looking for money in order to accomplish, right? I mean, at first it was just trying to find money in real estate. Now it's, now I look at something like RCN or some of the other private lenders in the space. We're lending on 30-year mortgages for, rental properties or rental investment properties at levels that are extremely close to what you might be getting at a local bank. So it's just amazing to see, and that's not possible without this Wall Street money inflowing into the space, right? These things don't exist unless this amount of inflow of capital comes through to allow the capital structure of the industry and effectively where things are today, which is a wonderful, wonderful thing for us to be experiencing as private lenders ourselves, and for the investment real estate industry as a whole. Whether if you're a borrower, you're thrilled about it, because what it means for you is you're paying less money for the loans that we're giving. You're getting less money down. You've got a more flexible product, and all these different things are coming into the mix now to allow you to scale your business, you to grow your portfolio. If you're never really into the business and you're starting to grow your business, now you have this industry that can help you scale so quickly. And that's not only for a onesie twosie new customer. We're talking about guys that, we see business all the time from guys that have 800 FICO scores and a significant portfolio. They can go to their local bank and get a good loan, but they're coming to private money. And the question is why? And we'll talk about it later, but
it's faster than a bank.
It is. It's just, there's so many benefits to what private lenders can offer. And the only reason we've gotten there is the sophistication and the organization of how capital has evolved over this period of time. And we'll talk about, the kind of future outlook and whatnot. We could dive through some of those,
there's so much to talk. I mean, I know there's a lot of people writing in the chat. Thank you so much. You're giving a amazing overview. Tay, any questions over there before? Because right now we're talking about kind of like how we started and how it's evolved, and then we'll go to the next topic. But just wanted to touch on if anybody has questions.
There's like a question from Samuel regarding the securitization. So his question is the lack of securitization the reason why capital markets have not been able to capitalize on international real estate? I haven't seen much investment into international real estate despite potentially high yields.
Yeah, so that's a fair question. I guess the answer is yes to a certain degree. I think, the only country, anything outside the United States, the only thing I've really seen any volume in is maybe a little bit in Canada and a little bit in the UK. Otherwise, we really haven't seen it. And it's just the ability to understand and value assets. I think what you see is Wall Street understands the U.S. housing industry. Wall Street doesn't necessarily understand the UK housing industry, right? They don't understand the housing industries of other nations or countries, so on and so forth. So it provides a little bit of uncertainty that results in
a lot of because there's the legal aspect of
correct. You've got that as well that you've got to deal with the legality and the regulations and everything else that comes into play. So it makes it a very, very difficult hurdle to breach outside of the U.S.
And there's a reason why there's a huge influx of international capital coming to the U.S. because they look at U.S. real estate as like more of a safe haven, especially like apartments or rentals, single family.
You nailed it. I mean, the amount of foreign money that has entered away from just Wall Street is unbelievable that we've seen. And we've seen it from all levels, right? We have seen a ton of investors come in and want to aggregate properties and use private money to do so. We've seen a ton of foreign, money sources invest in the space, whether it be through securitization or whether it be through backing whole loan sales or whatever it might be. We've seen a lot of that come through because the U.S. housing market is so reliable, so stable, it's so measurable at the end of the day. And I don't think you really get that in many other countries around the world.
Yeah, no, because I get pitched all the time deals, and I'm like, I don't understand the laws, and that's a huge concern. What are you going to do? You're going to go battle a legal battle in another country where it's I think these are the problems. U.S., something that we understand, but I believe Torax in UK, but I guess we could. I don't want to get off topic.
Yeah, no, there's a little bit of expansion that's occurring. They are, to answer your question.
Yeah.
And they do some business out there, and they're certainly looking to pioneer that entrant. But at the end of the day, it's going to be a while before we see anything substantial outside the United States, and that's just my candid opinion. But there's not an asset out there like a U.S. home. It just simply doesn't exist.
There's so many factors. There's
right,
and demand is right now.
And to your point, and I don't want to spend too much time off topic, but you're exactly right. Within the legality and the regulations and everything that occur, if you want to start doing that and investing outside the U.S., the amount of infrastructure that you're going to have to go through is so significant. And then you got to start asking yourself, am I going to be able to scale enough business to even rationalize going through all that? And usually the answer is no. So that's why you really don't see a lot of activity outside of that.
Yeah. All right. So, okay.
So we are about to get into the topic, the COVID. But then before we actually go into, I have a question from the audience regarding the SFR. If you can briefly touch on this topic. So
Sure.
Multifamily isn't necessarily only the recipe to scale, since as a single family rental is becoming as scalable as multifamily. How do loan products facilitate the growth of the SFR sector?
Yeah, absolutely. I think, as we were talking about the development of our space, this is a product that to me is the forefront of what we're doing today. And this might actually be a good time to pull up that slide that I sent you that I think would be a good breakdown. But as you're pulling it up, I'll kind of talk through it. When you look at the amount of availability in the world or in the United States right now, the estimated market value of the rental market is somewhere between $3.5 to $4 trillion in value, right? Which to me is just the amount of opportunity that exists is incredible. And then I see the chart here. Thank you for pulling it up. One of the things that I think is so interesting to look at is this little pie chart that we have here. If you go through the numbers and add them up, 85% of this rental market is driven by people that have anywhere between 1 to 10 properties under management. We're not talking guys that are driving this that have 50, 100, 200 plus properties. We're talking about guys that can go out there and aggregate a handful of properties. And that's what's driving this industry right now. And the way these loan products have come about, when you look at interest rates nowadays, from RCN's perspective and really from a market perspective, you see a lot of stuff that ranges anywhere from the mid 4s to the mid 6s on interest rate. They're traditional 30-year loans. And we're providing a high amount of leverage, usually somewhere in the ballpark of 70 to 80% LTV, and requiring the customer to come up with the rest. And what you have is this ability to go out there and instead of investing in a 10-unit multifamily complex and trying to find the big hitter that is going to qualify a lot of rents and bring in a lot of rental income and so on and so forth, by taking a multitude of rental properties, you get a couple of different advantages. When I say rental SFRs, 2 to 4 units, et cetera, you get this opportunity of, private lenders being able to offer you quick and efficient money. And what I mean by that is you don't have to go through the traditional, income, underwritten Fannie Mae process that takes 2 months to do. If you come to a private lender, you're really waiting on the appraisal. Once the appraisal comes through, you can usually close these loans pretty quickly, which allows you to create that consistent and quick level to scale your business. And when you're investing and scaling your portfolio with 1 to 4s and rentals, as you continue to aggregate, you got to consider the asset you're investing in, right? I mean, when I look at a DSCR-based product, which is the single family rental product and kind of the basis, we're looking to make sure it cash flows. And as an investor, you're looking to make sure it cash flows, right? So if your monthly payment with RCN is $1,000, you're going to want to make sure you're collecting rents of $1,500, right? Or something above that cash flow that's generating rental income, paying your mortgage, and building wealth for yourself. And as you're doing that, and as you continue to use leverage to aggregate more property. So in an example,
if you put 20% down and you get an 80% loan from us to buy one property, now you've got a little bit of money to scale your next property and buy that property and build another and another. But one of the biggest things to consider with the rental market today is home price appreciation in America. And right now we're at just an all-time high. And even through the pandemic, we still have seen that number go up, aside from maybe some highly urbanized areas, New York and San Fran and some of those places. But as you invest in these assets and as you're paying them down, and by the way, you're not. The rent you're collecting is paying the mortgages down. As you're paying your mortgages off, you've also got an appreciating asset. So as people are looking to scale these businesses, you need to go to MSAs and geographical locations that are, good locations, right? Hot MSAs, areas where people want to be in. And when you look at this overall industry right now and the dynamic of, the low supply that we have from a housing market perspective, coupled with things like millennials. Millennials want to rent. They don't want to buy. That's been a problem for the last couple of years that people are trying to solve for. But what we have is such a high demand of rental units throughout the United States. And the pandemic has only heightened the amount of rental products out there. But as you have this heightened demand for rental and you have that low supply, naturally what you're going to see is prices continue to go up. So not only are you collecting higher rents and being able to cash flow your property better, in the example I gave, you're putting $500 in cash in your pocket every month. And you also have the ability to where you only put 20% down and you can use the rest of that money to go out and buy another property. Or if you already have properties, you can come to a private lender and cash those out. And you can get 70, 75% for the value of your property. And one of the things that I think is very interesting in the space is all the different dynamics, if you think about a loan, are anywhere from ground up construction all the way to a long-term rental finance. And what you see people do is they'll go out and buy a property and they'll fix it up. And usually your leverages are higher for that. Usually you're only having to put 10% down, maybe 15% down. And you've got a lender helping you renovate the property, guide you through it, reimburse the monies so you can build up that property. And then you can just cycle that into a 30-year refinance. And you can take, let's say I go and buy a $100,000 property. I put $25,000 into it. That property might be worth $175,000 to $200,000 after all my renovations are done, right? So now if I go to refi that property, my basis is $200,000, and my investment of the property might be much less than that. So now I'm able to capitalize on the value, cash out, get some proceeds, and continue to scale my business that way by reinvesting in real estate over and over and over again, aggregating this large portfolio that's cash flowing, where I'm not paying the debt, but somebody else is paying the debt for me. And oh, by the way, 3 to 5 years from now, I might see that my property's appreciated 5 to 10%, and I've got an inherent value located in there as well.
That's a third method you're talking about.
Yeah, BRRRR's a common acronym that we hear. I think, what is it? Buy, rehab, rent, refinance, repeat, I believe is how it is. And it's truly a great method because with all the alternatives that are in this space right now from a lending dynamic, that level of opportunity and flexibility that somebody can give you as a lender to be able to say, hey, you want to go buy a distressed property? Let's go do it. And by the way, we're going to be there to help you renovate that property. We're going to be able to help you refinance that into a 30-year mortgage and let you go and do it again and again and again. You can do that. And when I think about a multifamily property, I think they're great assets. I think right now we're at a very odd time post-COVID to where you got to be a little bit sensitive about how you pick and choose what products you jump into. But there's a lot of costs that go into that, right? I mean, you have a lot of upkeep. You have a lot of marketing. You have a lot of insurance expense. You just have a number of different things that come. You got to make sure that vacancy is always not a factor. You got to make sure somebody's managing the property. There's a lot of costs that can fall into that. And as you're scaling single families, you don't have to go through those costs initially. It's a lot simpler because it is just one home that's being rented out to one individual or one family. And there's a little bit less upkeep that comes along with that. And as you scale, you're able to learn, you're able to kind of understand some of those logistics in a little bit easier of a fashion. And I think it's a great way to start your business. I think it's a great way to start your interest in the real estate market as compared to jumping right into something that, in my mind, is extremely hard to manage.
I agree with you on that. I know my father, and I know lots of investors, they start out with single family. My mom wants to get into investing, and the first, a lot of investors I see, they start out doing, flips, single family flips, and then they start getting to single family, maybe 1 to 4s, and start building up their rental portfolio because they want, when you're investing in flips, you don't have the tax benefits.
Sure.
Right? With the rentals, you take advantage of depreciation, appreciation. You have multiple benefits to really build wealth for yourself. And as what Justin was mentioning is, you could keep on recycling that money to keep on doing more deals.
Right. And I think the big thing to reiterate, and I know we've mentioned it before, and I'm sure we can talk about it a little bit after the fact during Q&A, but it's the flexibility of what we can do, right? I mean, this is not a loan where you go to your loan. I mean, I'm refining my current home right now, and it's amazing how much of a pain it is. Even though it's the most simplistic, home, it's appreciated, the leverage is low, everything's great. It's still taking forever. It's still going through a very monotonous process because it's an agency loan. It's a regulated mortgage. And when you come to the private sector, a private lender, and you look at all the advantages that we have the ability to offer, you have a common sense approach, right? I mean, if you have a 600 credit score, you're probably not going to be able to go to Bank of America and get a loan from them. That's just the reality. But you can come to one of us and get a loan. And we can get that done, right? There's so much flexibility, speed, common sense approaches that we can take to this collateral that allows us to help scale the business in the way you want to scale it. I mean, I can tell you that no investor is the same. Everybody has a different way of wanting to do things. And it's important, as our industry has developed, to be able to cater to those needs, right? Like maybe you're an investor that only wants to focus in a certain area. It's our job to partner and help you succeed your goal, whatever that goal might be. And we have the flexibility to allow for that, right? We have the flexibility to help you accomplish your goals however you want to accomplish your goals, right? And there's a multitude of options that we can offer as private lenders to help you get to that point.
Yeah, and another interesting option, I might have missed this, but I want to relay it out there, is that, I was discussing this before we had more guests join us, is that I hear a lot of people in this space, they start off with single family and they hear the notion, well, in order to scale up, you got to go to commercial, you got to get into large multifamily. And I would love for you, Justin, to explain that that's a fallacy. You could scale up single family with, like, let's say there's a 100-unit scattered site portfolio. I get these emails all the time. Single family homes are scattered.
Sure.
You take them down with one loan.
You can do it, and the products exist. We certainly have it, and many others do. I don't know if that's the right answer. I think if you want to do it right and you want to create a successful business model, I would offer up the alternative. I would offer up the ability to go and invest in one property at a time and scale your business up that way, because you're going to learn lessons. You're going to understand what works and what doesn't. And you're going to have everybody wants to go out and they want to make as much money as they can as quickly as they can. And I understand that. That's something everybody as a human being wants to do. But in order to be successful as a real estate investor, you've got to learn how to do it right. You've got to learn how to grow your business. And if you jump into a multifamily property, or if you jump in and you go out and you buy a portfolio of 20 properties day one, you don't get that ability to learn your lessons. You jump in, and if you mess something up, you're in a big amount of trouble. Right.
That's more for sophisticated.
Right. It is. And I think COVID's a great example. Right. And I'm jumping the gun here before we get to the topic, but think about COVID. Think if you went out as a new investor today, and let's say you went out and bought a portfolio of 25 properties. Let's just use that as an example. COVID hits. COVID is, when you think about this, rental industry, it's driven primarily by workforce housing. And when unemployment spikes and you've got people losing their jobs and you have governments offering, forbearance plans and deferments and all these different things, and you just bought 25 properties and now you've got 15 to 20 tenants who are saying, I can't make my payment. I lost my job. What do I do? If you just went out and did that and you've got no experience, you're in a tough spot, right? I mean, like, you don't have the experience and the lessons learned to know how to navigate that in the right way. Whereas if you've gone out and you've done one property here and one property here and one property here and scaled it up in that way, what you start to figure out is you're going to come into situations where you've got to deal with that, but it's only on a property. It's not on 20 properties all at once. And you've got other properties to help you, counteract it. And you learn some lessons and you learn how to navigate and learn how to properly manage it. And you get to points where, if you went out and bought 20 properties, maybe you think you can manage them all yourself. But maybe if you scaled it up one by one, at property 4, you realize, I can't do this. Somebody else has got to jump in and help me out. And you just start to kind of develop some of those characteristics that, in my mind, lead to a successful real estate investor. And that's by learning your lessons. It's by, diversifying, which I think is important. It's by partnering with the right partners to help grow your business and help teach you the lessons that they've learned the hard way. I know I've certainly learned a lot of lessons over my years on what not to do. And I'm happy to share that with our customer base, right? Because we want, if they're successful, we're successful, everybody's successful. That's what we want. Yeah. But it is is fallacy the right word? No, because you can go buy a portfolio tomorrow of properties if you wanted to, and you could have quote unquote scaled up. But that doesn't mean that it's going to be successful. It doesn't mean that you're going to be able to handle it. And that, to me, is the bigger facet to focus on. In that,
you want to be responsible. That's really what you want to be
responsible, right? I mean, I think it's, you have to do things the right way, and sometimes the right way takes time. But in my mind, by doing it the right way and scaling it up in that direction, if you want to go out and buy a large portfolio of properties tomorrow, you need to have somebody that you can bring into the deal that has that experience, that's gone through those lessons, right? You need to have a property manager that knows exactly how to handle those situations. Yeah. But if you're trying to do it by yourself and you're trying to learn, going through almost methodically, growing your portfolio one by one and picking good assets and appreciating areas and cash flowing assets, you can really start to figure out how to do business. And while you're doing it, you get to understand all the variety of options that exist out there to help you grow your business, right? Maybe it's working with a different lender. Maybe it's understanding what different lenders have the ability to offer. One thing I tell everybody, and it's no, benefit to me, but if somebody comes to me and they say, well, my local bank's offering me this for my long-term rental loan, go take it, do it. Because I'm not going to sit here and tell you that I'm cheaper than your local bank. That's not the point of our money. Our money is for flexibility and to help you scale, and theirs is not. So you can do that up to a certain point. And of course, there are caps and there are things in place to where they might have to come to us eventually anyways. But I tell people to do it. And the reason I tell them to do it is because they understand what the process is like with a local bank. They understand what it's like with an RCN. They understand what it's like with a lender A, B, C, D, E, F, G. And you start to kind of gather this intel that allows you to understand and have this mastery of the space to scale your business in the right way. And I think that's incredibly important.
I agree with you. I run into this too all the time. I go to a local bank, and really it's relationship based. And I tell them, if you could go to a bank and you're bankable, go for it. If you have the time to close, and you could, do that, because you know what? They'll come back.
Yeah.
Eventually.
Right. I mean, you're 100% correct.
It's a relationship. I love what you're saying, that the guidance, another thing about being a lender is you want to be able to stress test the deal, because you want to make sure that the borrower is going to be successful.
Right.
That's another important thing. So when you're talking to lenders, like I know, Justin, you know your stuff, RCN, RCN Capital, my partners, they've been flipping houses for the past decade. So a lot of people come to us because, maybe our money's cheap, maybe it's a little bit more expensive, but it's us. You're dealing with us. You're dealing with someone that understands construction, that can look over a budget and tell you if that budget was put together well.
That's right.
Help you put together a draw schedule to make sure that you're going to get your money. And you wouldn't believe the amount of times that people come to us to bail them out because their lender never reviewed their scope of work.
Yeah, I mean, and that's there's power in no in the industry, and you're exactly right. You guys have the experience to understand, and that's a great asset to the space, right? Because if you have the power to say no, I'm not saying no to protect RCN. I'm saying no to protect my customer. That's crucial. If we see a project that doesn't make sense, I'm going to tell you it doesn't make sense, and I'm going to tell you why and what we've experienced and how to prevent yourself from falling into that trap. And you're doing the same from your perspective and with your partners as well, and from the same level of experience, right? You know what works and what doesn't, and that's where it all comes back to partnership, right? Guidance and education and knowing that your local bank is not. I mean, they might be looking at some of this stuff, but they can't take common sense approaches to certain things because they're so heavily regulated. We can, right? We can go through the process and really tell you what we think works and doesn't work and so on and so forth. So 100% agreed on that.
Also, before we move on to the next topic, Sue, but I believe also banks, they require you to close in your personal name.
Correct. And that's a big, I think one of the coolest things about the industry that a lot of people that have invested in it realize is, we, for the majority of time, require you to set up an LLC or a business entity, and that doesn't appear on your credit report, which is a huge plus, in my opinion. It's not a credit reported asset at the end of the day because it's within your business entity, and it allows more and more flexibility. Again, offering up different options to help you succeed in the best way possible.
And the one thing I for borrowers out there just to be careful of, I've seen it happen. So you have a lot of capital providers out there, and a lot of lenders, they work with multiple capital providers. And what happens is a borrower thinks, let's say they come to me, RCAD, let's say, for example, or they go to RCN, or maybe they go somewhere else, whatever it is. And then they think they're going to get different money from another lender, but that money's coming from the same source.
Yeah, that's exactly right. It's a round robin at the end of the day, but you get different relationships, you get different experiences by going to these different varieties. And it's a great way to just, knowledge is power, right? That knowledge is power. So as an investor, we'll both be the first to tell you that we'd love to capture 100% of your business. But if I'm speaking to somebody and trying to help them understand what it takes, it's diversify. It's know what's out there. And that might be bringing somebody 100% of your business, but it's knowing what's there so you can know what's best for yourself. And we talk about capital markets on a whole, knowledge is power, right? And understanding how the construct is and what goes on into it is effectively what allows people to start fluctuating and creating new things and driving down pricing and so on and so forth.
Yeah, and one last thing on this before we go is if you're a beginner, I always tell people partner with someone with experience, because what ends up happening is that an experienced borrower is going to have better terms.
Yeah,
they're going to have more leverage with a lower rate, and you're going to protect yourself, right? You may have to give up a little more of the lion's share, but you're going to gain experience. You can protect yourself because there's a lot of. It's not like HGTV where you're going out with a sledgehammer and this is fun. This business could be fun, but
we actually find that the HGTV customers aren't doing great on a lot of stuff. Don't believe what you see on TV. Hopefully everybody knows that by now, but it's it is. It's you're exactly right. You get better terms, but you also get the guidance of somebody who knows what they're doing and can teach you some lessons along the way.
We do that a lot of times. We pair people up. Maybe someone has bad credit, so we say, okay, you need a credit partner.
Sure.
And we do that. We match make a lot, But let's get to the next topic. I think that I
want to be mindful of time, so I'm going to speak just a little bit on COVID for a couple of minutes here.
COVID was scary. That was a scary time. COVID, the capital markets. This is completely shut down.
And I want to make sure that we're able to spend a little bit of time here talking about the future outlook while we've got the time ahead of us. But COVID was, when you think back to how we started this conversation, we talked about capital markets. COVID was, working in the bank at the beginning of my career for many years, you went through things that were called stress testing. And stress testing was effectively running a bunch of different business scenarios and a bunch of high-level stress situations against different pieces of your business to understand how your business operates, to understand how your business would, survive during certain, time periods. And as business models, we all think through these different things. What happens if this, if that, so on and so forth. COVID was the best stress test of all time, because nobody could have seen the impact that COVID had to the world as itself, right? But in regards to our market and capital markets, the impact it had there, nobody could have prepared for. And what was that impact? Everything shut off, everything. And we'll talk about a couple of the reasons why. But when you look at COVID, what it did was it provided a level of uncertainty. And the word uncertainty, no matter what you're talking about, creates volatility and it creates a bad marketplace. And when you look at what occurred, people started to fear what was going to happen. And when you fear what's going to happen, you pull your money out. And when you start pulling your money out, people stop buying loans, like we were talking about earlier. They're no longer deploying their monies to purchase loans because they don't know what the heck's going on. You've got people that own some of that securitization paper that they invested in. They're trying to trade it and get rid of it because they don't know what's going to happen. So they want to offload as much risk as they can to make sure that at the end of the day, their risk position is light. They don't have to worry about it as much, right? So just think about those two things as a whole. You just lost all your investors from buying loans. And now you have a securitization market that's trading at levels that are so chaotic because people are just trying to get rid of the paper as quickly as they can, that now you've got a price point that's not defined. It's too volatile. And then trading ceases. The marketplace stops. Nobody's investing. Nobody's trading paper. And when that happens, it goes back to my original example. If a stock trades 2 times in a day, the price is going to fluctuate severely because there's no consistent price point on that paper. Same thing goes for securitization. If all the trading stops, if all the new securitizations stop, all the investing stops, we don't have a price point to work on. So as a lender, I just had something that was so stable and so consistent that I could rely upon go away. And now I have no idea where the price point of that is. And this is just speaking from the capital side. When you, and I'm sorry, I'm getting a little stuffed up here. When you, I know we're both battling it, but when you kind of look to COVID as a whole and the things that we were looking out for, there's a handful of things that you had to be mindful of. And this is what was going through the lender's head as well as capital providers out there. First and foremost, loan performance. What's going to happen? We gave the example earlier about tenants stop making their payments. Government moratoriums were coming into play. People were offering up deferment periods. You could not pay your mortgage or pay your rents and you were fine, was the mentality that people were taking. So that's great. That helps the house, that helps the U.S. Population survive. But from a lender, from somebody that owns these assets, you're in trouble, right? Because now all this stuff is not making their payments. So what are you going to do? How do you adjust your business model to adapt to that? Because that's a problem, right? I mean, that's something you got to worry about. Then you got to worry about home prices. What's going to happen? Are home prices going to decline rapidly? How is this whole marketplace going to adjust to what's going on? You got to worry about the stimulus packages and when they're coming and what that means for the industry as a whole and so on and so forth. So you've got this multitude of things going on at once that are directly caused by the pandemic. And in our industry, you were stuck. You had to pause. You had to just take a step back and say, we got to figure this thing out. That's what we did. That's what a lot of lenders in the space did. But it resulted in this volatility and this uncertainty that amounted to us having to take a step back and understand what was next, what was to come. And at first, you had to understand what was going on with the virus and how it was having its impact in the marketplace. You had to have conversations with everybody. When do we think we're going to start buying paper? When do we see a real point where we're going to see volume again? and get things moving? When do we feel like we're going to be in a stable enough position from an economy perspective to start lending again? Know that this paper is not, the prices aren't going to move and so on and so forth. And how do we properly evaluate paper? And what you saw was kind of a reset back to this day one. From our perspective, we messaged out a very clear message, which was we believe housing fundamentals were strong, and they proved to be so, right? When you look at the housing fundamentals of the U.S. Real estate, you've got an incredibly low supply and incredibly high demand. And that's going to create a stable home price. It kind of goes back to economics 101 back in the day, right? That offset is going to allow home prices to stay high because the demand's so high and the supply is not there to offset it. So we felt really good about home prices. Like I said, the only thing that we were a little concerned with is fleeing from urbanized areas, people trying to get away from the urbanized, Manhattan, New York, San Francisco's, and trying to get to more suburbanized areas. That was kind of our initial, thought process that we were behind. Part two was understanding what we needed to do as a lender to properly structure our paper on the going forward. That means we need to adjust leverages. That means we need to change our underwriting standards to look at COVID potential issues. We need to maybe factor in an interest reserve to account for somebody taking 6 months of deferments on their payments at a given time because they lost their job or something of the likes, right? So we have to go through that process of resetting the point of where this price is at. And oh, by the way, go back to the beginning of the conversation, we don't have securitizations right now. We don't have capital providers buying paper. We've just got our money. No, nothing's there. So we've got our money. So what does that mean? We go from that 6, 7, 8% range back up to 12%, back up to 14%. You're kind of back to this reset to day one while trying to solve to get back to where we were in February, right before the pandemic hit. And it was a unique balancing act that you really had to try to work yourself around. And at the same time, you're trying to figure out how to keep your lights on because you're not closing loans, you're not doing business. So you've got to make sure that you've got money coming through that allows yourself to not only service pre-existing assets, but make sure that you're prepared to, position yourself to come out of this strong. And that's really the final, point of performance. And, I'm speaking on it on a somewhat high level, but you've got to look at your portfolio of loans. You got to understand if it's performing or not. You got to understand if you're getting money in or not getting money in and how you can get performance to be high. You've got to understand how to structure new loans to make sure their performance is high. And you've got to really understand something that's not easy to understand, which is COVID. And we still don't understand it for that matter to a large degree. We just know that we're hopefully getting to the right, taking the right steps to get there. But, that level of, I guess, uncertainty and not understanding what's happening, you don't know when employment's going to go back down to stabilized levels. You don't know if other spikes are going to occur. You don't know how the housing market or the workforce housing is going to react. And let's say, things stabilize in July and October, there's a hit. How do we prevent ourselves from getting affected by that, right? Interest reserves, new lending dynamics, new things come into play that effectively get us to that point. But what COVID was a setback. What it allowed people to realize was all the mistakes that they made that they could have prevented. And nobody could see it coming, but you could always look in hindsight and say, what could I have done to make this an easier process to navigate? And I think what a lot of people learned was making sure you were diverse, making sure that you had a lot of availability out there in a bunch of different facets, whether it be securitization, whole loan sales, multiple investors, multiple banks, whatever the case might be. You had to make sure that existed. And I think the same is for some of the borrowers and investors on our call today. If you're going through one lender and they stop and they screw you over and they can't service your loan, I bet you wish you would have had a couple other lenders that you could lean on, right? I mean, that was a reality. And I think that's what we saw is that hindsight of looking back and learning from mistakes and trying to prevent those from occurring. But that was a pretty, that was a 6-month time frame of trying to figure things out. And the remarkable thing, which, is a great segue into what is kind of our final topic, if you will, is after that 6-month period was over, after people had a really good chance to assess the marketplace, assess the housing market, actually see how strong housing fundamentals are and how this industry, how strong it performed despite how heavy of a stress that it was. And keep in mind that people weren't stopping because things got bad. People were stopping because they didn't know what was going to happen, right? And after seeing a couple months of, hey, this is okay, right? Like, we're surviving. Things are, I mean, we're trying to navigate some issues, but our paper is performing for the most part. This is a resilient industry. This is, families that don't want to lose their home, and whether, if they've got moratoriums and deferments available to them, they might be taking it, they might not, because that home is their home, right? I mean, that is what they're living in. They don't want to lose that. So they're still trying to make their payments. And that's usually debt service one for a renter, right? I mean, you've got these renters, I mean, that's what they want to pay first, is to make sure they don't lose the roof over their head. And we saw this interesting dynamic to where, of course, there were deferments and forbearances and spikes and performance issues. But on a holistic level, looking at what we were able to accommodate in the industry, it was resilient. It really survived pretty well. So you've got lenders and capital sources looking for ways to restart at different levels and try to reevaluate where they need to be. And at the same time, you've got this performance you can lean on that says, great, right? This is, if we can survive COVID, this industry can survive just about anything, which is remarkable. It was really impressive at the end of the day.
Probably a lot of stimulus that helped.
The stimulus, of course, those things were massive. And that was a big focal point, is when's the next stim package and what's that going to look like? And the government intervention was a big focal point for a lot of different parties, because you had to understand what they were going to do to really fully assess what's going to happen. And I think it's going to be a great segue, but it's not over, right? I mean, none of this is over. And deferment periods, forbearances, government moratoriums, all these different things, the music's going to stop at some point. The government's not going to be able to keep giving people money. The government's not going to be able to honor these programs anymore, and people are going to have to make their payment. So it's going to result in an opportunity, which we'll talk about at the end of the call here. But I think it's a unique opportunity to where, there are some people that are really surviving well and performing well because, going back to our previous topic, they learned how to scale and learn their lessons to where they can survive things like this. And there are people that aren't prepared for it, that are surviving by, a hair because of the intervention from the government and whatnot. And when situations arise where stuff comes due, you're going to see a level of inventory pop up in the U.S. housing market for, and it's sad, and I hate to say it, but foreclosures begin to pop up. Discounted buys begin to pop up. Banks are just trying to get their money and get out. Short sales start. And you get this new inventory that enters the market that, for the investors on the call tonight, have a tremendous amount of opportunity to jump into investing. And yes, it's a sad, way from an industry-wide perspective to look at, but the very real reality is it's an opportunity. So there's a lot that's going to stem from this. But going back to the final point of COVID, as we started to see the performance relatively stabilized, you start to just, from our position, we had confidence. So we went out and we started lending because we started to have confidence in what we were doing, and more people started lending.
How long did you pause for?
So we paused towards the end of March. We closed some loans every month, where it made sense, but we were really paused from the end of March through May. And we really started to lend again in June. So there was a decent length of a pause there where we were trying to rebuild and grow. And then there was a moving target we were trying to hit, which was understand what our product needed to look like and how to best service our clients. And what we found was as our clients and as the investors were so resilient, they still expected the same terms coming out of COVID, which is crazy to think about, but it was the reality. And what we quickly found was, going back to that day one reset, and we weren't quite there, but we were pretty up there in, reduced leverages, interest reserves, and a higher interest rate. Those are the three main things that people had going for them early on. And we were finding that people didn't necessarily need our money. And it was a unique phenomenon. I think when you look at this industry, and I was reading a unique stat the other day, and I don't know if I marked it down somewhere, but I don't know if I have it. But it was something of the likes of like 40% of all fix and flip deals in the nation, or somewhere around the 35 to 45% of all fix and flip deals throughout the country use debt, which means the rest of them are just using cash to do these projects and do these deals. And those are your high quality, high net worth, high liquidity individuals. So what we found was we were struggling to win business because the guys that were still investing in real estate were people that were in a very stable financial health. And they didn't necessarily need our money to go do that deal. So our money was a nice to have to scale the business. But if we weren't priced at the right leverage and the right price point, it didn't make sense for them to utilize.
They might have had private investors.
That could be the case too. Right? There's a lot of different, different ways they could be generating some monies to invest in their transactions.
Yeah.
But the reality was, unless we were priced correctly to where it made sense, they didn't really necessarily need to use us. So we we still did plenty of volume and had a lot of business going on, but we quickly learned that we had to find a good middle ground to make sure that we were covering our bases and making sure that we felt comfortable against more COVID spikes, while at the same time meeting the needs to help scale the business for our borrowers, investors, and so on and so forth. And fast forward to today, we're lending more aggressively than we were before COVID.
It's like a V-shaped recovery.
It is crazy to think about because we started here, we went straight down here, and now we're way up here. And I think we see that in the industry. It was such a great stress test because so many lenders, so many investors, so many borrowers, everybody that touches this space learned lessons about what to watch out for and what can happen, but B, and most importantly, the resiliency of the housing market and investment real estate. And it allowed this just amazing story to be formed to where now today we're able to know how to protect ourselves from potential issues like this. But we have so much confidence that we're out there lending at levels that are to a degree more aggressive than they were before because our level of confidence is so much higher. And you've seen the same rotation of confidence come as securitizations have turned back on, as paper has started to trade, as people have started to buy loans again. And it's all driven by capital markets. The end, reason for tonight's, conversation, this all didn't happen overnight, right? You had some people start trading loans again. You had somebody finally go out and try to execute a securitization on pre-COVID loans. And as this stuff slowly progressed, we started to understand a little bit more, where's Wall Street at? What are they feeling? What are they thinking? We started to see foreign money and try to get a feel for, what are they thinking? Where do they think this paper needs to be? And if you go back to the beginning of this call tonight, you needed that little bit of volume. You need that little bit of traction and consistency to start developing a price point and a construct to what the product looks like. And once it started, and once we all started to see that, while there were some people that are no longer in business, while there are some people that took major hits and are struggling to recover, the ones that had the business models to survive, we started to see there's still a lot of confidence here, right? I mean, people still got to make money somehow, some way. And do you want to invest it in a Treasury or do you want to invest it in an SFR? And you started to see really quickly that level of confidence still existed. That level of interest was there. And it was the snowball effect. You had 1 trade, 2 trades, 10 trades, 20 trades. The next thing you know, you've got this consistent amount of volume that's occurring that gives everybody that's cognizant of what's going on in the space a construct for what needs to happen next. And then it just skyrockets. And it positions us to go from really, really strong business to resetting and rethinking business to really, 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 really strong business, which is kind of where we're at today. And, COVID is a disaster and a pandemic, but in a way, there are silver linings that came from it in ways that have taught a lot of people how to, create resiliency in your own business models, no matter what part of the puzzle you're in, whether it be from a borrower perspective, lender, bank, investor, whomever. You learn lessons, and that is what results in success is learning lessons the hard way and being able to develop a resiliency and a business model around that to continue to scale your business in a successful manner.
So do you think, like, hypothetically, let's say I'm an investor and I'm looking to buy up single family houses. Let's say I'm doing the Burr method, right?
Sure.
And my exit strategy is to refinance it to a permanent loan, right? And what you have to think about is like, wait a second, can there be a shot in the next year or so where everything just shuts down again and I am stuck? Or do you think the industry is more resilient where if there is some type of another wave or whatever, it's not going to be such a shock to the financial system because it's already right?
And I think that's what it comes down to, right? Is the shock has occurred. So COVID is no longer a question. COVID is here. And we're always prepared. A lot of the decisions that are being made today is as we're writing loans, as we're looking at refinances and different strategies and different loan opportunities, the shock that occurred in COVID, if another spike occurs, the market isn't going to tank because we know what COVID is like. And that is when you think about the marketplace, whether it be the stock market or any other, traded marketplace where there's volumes occurring, consistency is everything. So any sort of shock, any sort of uncertainty always results in a problem. COVID is no longer an uncertainty. We understand what it is. We understand what it can do. And I think what people realize is there's no way it can do any worse than what it did. I think that's kind of the mentality. But if it does, and if we do see something to where unemployment spikes again, and we see another issue where stay-at-home orders are in place. I mean, think if you're doing a construction loan and they put a stay-at-home order in place to where you can't go out and do your construction anymore. You're in a tough spot, right? As lenders, in private lending, we've constructed flexibility around that to help people out, of course. But that's a tough spot to be in. As somebody that owns a rental property, if your tenant can't make payments, you've got to start making those payments. But what we've started to do is, those lessons have been learned. We know what could happen in a very, very high stressed environment. So we're doing things to protect ourselves from it. We're making sure that, if we feel like we're coming up against a point where, where COVID might spike, we're looking at somebody's liquidity. We're looking at somebody's assets to make sure that they would be able to handle the deal and survive that, right? So there's different mechanics that have entered into the space and lending practices and so on and so forth to where that's not quite as much of a concern maybe as it once was. That's
good to know. That's really good to know because as a lender, I want to make, and also as an investor buying, you want to make sure that, we're not going to run into this shutdown again.
Right. Yeah. It's always a concern, but the shock's occurred. The uncertainty's already been gone through. So now everybody knows how to react to it as it occurs again. And just the ability to navigate the uncertain and know that confidence level is there is so important to the health of this industry.
What's interesting is just like this whole shift from urban to the suburbs was like the perfect storm.
Right.
So you had flippers that were like worried about resales, and now they have bidding wars.
Right. It was crazy. I mean, it was remarkable to see. And I think not only that, but to take it a step further, so many people got used to this stay-at-home order that all of a sudden you're looking for office space in the fact that you're looking for a home. The two are the same, right? I mean, you're not looking for a home to live in and an office to go to. You're looking for a home that you can work in, and that's your office. And what you saw was not only these bidding wars because so many people were fleeing urbanized areas and moving into suburbanized areas, but you had people that were looking for new homes because you're stuck in your walls all day, right? I mean, now this is your office, and this could be your office for a long time. Maybe now's the time to look for a new home. And it was that, again, the undersupply and the high demand just created this healthy marketplace for home prices. And there's still a lot of opportunity to increase the supply, and that comes through ground up construction, that comes up through fix and flip, that comes up through different loan products that we have. But it was a unique phenomenon that occurred that really, positioned the housing market in a pretty solid way to where, were home prices struggling in New York? Yeah. I mean, there were not unimpacted areas. The urbanized areas got hit, but the suburban areas, which make up the bulk of the United States, were flourishing. So the marketplace as a whole was reacting to a degree positive towards it all, which is something that a lot of people didn't expect. They were planning for the worst. And it was almost a shock in and of itself to see the reaction that occurred throughout the housing market as a whole, and in our market as well from an investment real estate perspective.
Oh, yeah, no, I see it. I saw I could go in the luxury market, took a dive.
Yeah.
In New Jersey, and all of a sudden people, they now they instead of living in a little box in Manhattan, they could buy a big mansion.
Exactly.
And yeah, there's so many positive things that we saw. Now let's get into Tay, where I know that you're following the agenda. Where do you want to take it?
We've been already discussing the opportunities, a future outlook along with the COVID. But then I know that Justin, you briefly touch upon the upcoming foreclosure, right, as an opportunity. So as we all know, a moratorium is still keeping the foreclosure pool at bay, and a lot of investors are preparing for what's to come in 2021. Yeah. So when this moratorium gets lifted, from a standpoint of classes of homes, Class A homes to Class D homes. So in your opinion, what's going to come down more in the pipeline for the foreclosure market? And
that's a great question. It's tough for me to answer that from a quality and a class perspective, because so much of it depends on who the operator is behind the home. When you look at moratoriums and government plans and whatnot, right now you can't foreclose on a home, right? I mean, there's a lot of things that are preventing you from, maybe you don't have to make your payment right now, or all these different things. As stuff wears off, it's tough to assess if it's going to be a Class A, B, C, D property. Rather, it's really just going to be driven by the operator behind it, because the question becomes, when that payment plan stops and when they have to start making their payments, can they do it? And if they can't, the bank's going to want to take back that property, and then you start having this foreclosure opportunity occur in the space. I'm not really sure what to expect, and I don't really know if many people are, right? I mean, I think there's a lot of opportunity in urbanized areas right now. Absolutely. I think you'll see a lot of inventory pop up there. Yeah. And in suburban, you're going to see really high quality inventory coming to market. I don't know if a lot of it's necessarily going to be distressed.
Is it because of the foreclosure crisis in 2008 was due to bad underwriting?
Correct.
And now the underwriting is different, all going for the next decade. So which means these houses, what I read in the Wall Street Journal, we're looking at homes that are equity rich, but the owners are cash poor.
Right.
And I saw an article in the Wall Street Journal that there's PE firms or private equity looking to come into to buy single family homes through a sale leaseback, which is typically a commercial transaction because they have equity.
No, you're exactly right. So there are a bunch of different things that you're seeing, which are unique, right? You're exactly right. When you look at the crisis, it was leverage, right? I mean, you didn't have to put money into a home, right? So you're exactly right. It's a completely different dynamic in the way that underwriting has occurred back in 2008, 2009 versus this pandemic. But you're exactly right. It's the cash poor piece of this component. So the question becomes, as you look through all the housing market that exists out there, there's a couple different dynamics you have to look at. One is the equity in the property. And of course, right now, interest rates are so low, but you're seeing a refinance boom. And a lot of people are trying to get those low rates, but a lot of people are trying to cash out and get some funds to survive. And that's going to help them navigate themselves through, the end of their moratorium and their deferment period, right? And I think you'll see a lot of that initially, excuse me, where where we see a lot of the U.S. population when their deferment period comes due, and we've already started seeing it in private lending, where they want to refinance and they want to try to cash out on the value of their home to survive that because they simply can't make the payments on by themselves. So if the value in the property's there and the equity's there, and they can find a lender that helps them cash that out, i.e. a private lender, which is a phenomenal example for this. If you can, if it makes sense for your particular
But it has to be non-owner occupied.
Right, non-owner occupied is crucial, right? If it's owner occupied, then you're in a different spot. But if you can find a way to refinance it, roll those deferments in, put them to the payoff, do different things like that, you can survive. You can navigate. But there's just going to be a lot of clientele out in the industry where they're not going to have the ability to do that. Maybe they've got a second mortgage on their home already, and they don't have that equity there. Maybe they don't have, the abilities to cash out enough to put that to the tail end of the property. Or maybe you've got people who are investors and have an aggregation of a number of properties, and they can only manage to save a couple, but they can't save them all. And you're going to have this interesting, phenomenon to where it's not property specific, but it's really just trying to understand each individual and what their abilities are. But as an investor, I think it's important to be savvy and to be very in touch with the markets that you're investing in, to have a touch point into the foreclosure market, because you're not going to be able to target certain markets immediately because the entire nation is impacted by this. It's not one place or another. Maybe you could argue that, states with higher COVID rates might have a higher likelihood of inventory. You could maybe argue that to a certain degree, but the reality is this is going to exist everywhere. As an investor, it's just important to make sure that you're tied into the touch points of how to identify those opportunities quick and early on, and have the wherewithal to be able to have the experience and understand what it takes to go get that property quick, because it will be a bidding war. You might have a property that's selling at a 25% discount and it gets bidded to a 15 to 10 to 5% discount. Still a good deal for you to go get, but you got to know what you're doing, and you got to be able to be prepared to jump into it quickly in order to do it.
Yeah. So, and talk about opportunities. I mean, some things that I believe are going to be opportunities is baby boomers are going to be looking. From what I understand, a lot of them they're not rolling with cash in the bank, which is it sucks. It's a reality. They have equity. Their houses haven't been renovated for 30 years.
Yep.
And that's an opportunity for investors to go after. I know some. There's estate sales. There's baby boomers that they're on their way out. They got to downsize. Maybe they're going to senior care. Maybe they're going to the Carolinas. But the problem is they have equity. Maybe they can't make their payments.
Right.
But a sale is better than a foreclosure, because at least they
realize their opportunity and they say, look, I don't want to have a foreclosure blemish my credit. I can get out of this property. And as long as I get out of this property and I can sell it and do something with it, that's a better alternative than letting it go through foreclosure and potentially prevent me from getting a loan 12 months down the road, right? I mean, if you look at the restriction in private lending, you don't have to have a perfect credit report by any means to get a loan in a private lender perspective. If you're trying to go buy a home for yourself that's owner occupied through a traditional agency loan, you need to have some pretty clean credit, right? I mean, you got to have your act together there. So you're exactly right. They see the opportunity cost and they say, I just gotta sell it, cut my losses, not take the foreclosure, and when I'm ready, I'll jump back in. And what that opportunity presents goes to the BRRRR strategy, like we talked about earlier, where an investor can go in and maybe buy that at a good price or a reasonable price. It's a distressed asset that needs some touch-up renovations, that can get a new paint job and maybe refresh the appliances or something. They can get a 15, 20, 25, 30% return on their investment. And they have an option to either sell that property as an investor and make a little bit of a profit, or if they feel like there's a lot of home price appreciation that's going to occur over the next 3 to 5 years, they can decide to refinance it and hold it and rent it out and let that property value go up. And again, it goes back to that example earlier, right? You go buy a property that's $100,000, put 25 into it, you've got $125,000 invested. But if it's now worth $175,000, that's a good profit. That's $50,000 in profit right there that we just managed to obtain in the property. And if you decide to, say, you know what, I'm going to refinance it, I'm going to hold it, and let's see where the property value goes. 5 years from now, that thing might be valued at $225,000, and you just made another $50,000. Not to mention you were collecting rental income on the property in the meantime. So having all those options and all those loan products and opportunities that exist, coupled with being in touch and understanding how to properly assess inventory that exists in the space as an investor, that combination of understanding how to scale the business and what's out there to help you scale the business, and to have people partner and explain to you how to scale that business as a lender like yourself and myself, and then also having the wherewithal to understand where to jump in and say, this is how I can, identify inventory in this market and this market, and this is how I can jump into a deal early on at a good price. That's a deadly combination as an investor, because you can really position yourself to have a ton of success when all is said and done.
Yeah, that's great. Tay, where are we at right now on the questions?
Yeah, so we have some questions. We had actually a question early on from where is it? Rob. So do you ever lend on short-term rental income? Like
question.
Yeah, it's a great question.
Yeah,
short-term Airbnb, VRBO, vacation rentals, that sort of thing. The answer is yes. Pre-COVID, absolutely yes. You saw a ton of it. You saw, the underwriting is a little bit different. Instead of looking at, a traditional lease, you're looking at the amount of income that property's produced over a certain time period, 6 months, 12 months. You want to kind of get an understanding as to what the vacation rental status is. And usually it's a higher rent. Usually it's a higher income generating product. COVID impacted that for obvious reasons. People weren't vacationing. People weren't going to different states because they were on lockdown. They couldn't move. We've seen a resurgence of that for sure as time's progressed and the industry's normalized. I think there's still some hesitancy because vacation housing and seasonal rentals still are a little bit of a wild card, because while people are starting to travel and vacation a little bit, there's still not everybody doing it. There's still a lot of stay-at-home order in place and a lot of government ordinances that exist that don't allow people to want to go somewhere. So people are still looking at that a little bit more. And I think you're finding that a lot of lenders and capital providers are just being cautious with it. They're trying to really make sure that the deal makes sense and time it up correctly. So the answer to the question, yes, it exists. The underwriting is similar. You're looking at rents and how that equates to your debt service. But the amount of, appetite for it has drastically reduced after COVID and is slowly starting to expand. But we really need to start seeing more and more consistency. And I think the vaccinations that are rolling out are going to be crucial to this, because then you start seeing a little bit of relinquishing of these orders. And that's going to allow for more travel, more vacation, more opportunity, which is what ultimately allows vacation rentals, Airbnbs, et cetera, to become such a attractive product to lend on.
I'm ready for a vacation.
I am too.
right.
So, I guess for the Airbnb, if let's say there's a scenario that someone has, you want to look at the rental income. Now, what's the leverage look like? I'm sure there's reduced leverage. You're not going to 80 on a purchase.
I would say post-COVID, the answer is yes. It's a slightly reduced leverage. I wouldn't expect that for long. When you look at our private lending business models, we're asset-based, right? We look at the project. We want to make sure that the asset itself works. And an Airbnb works really well. So from our perspective, if we've got, the ability to look back and see that it's a consistent, stable cash flow. It's going to perform well as an asset. I would say post-COVID, you're probably looking at a 5% leverage reduction, but the reality is that's going to go away and it'll go back to a very normalized model once it becomes something that people can rely upon again. Which, if you were buying a property or a loan, and the only way that loan generated income was seasonal rents, let's say you bought a beach house and the bulk of your rents come over the summer, if that's in an area where you got to worry about a COVID spike and people not wanting to travel as much, the attractiveness of that investment goes down a little bit. So as we start to see more stabilization throughout the country, and that level of uncertainty goes away, it's going to go back to a very standardized approach, which is more FICO driven and things like that to develop what your leverage is, and not so much any sort of reductions that are associated or attached to it.
Got it. So if someone has a scenario now that you guys would be interested, essentially.
Yeah, we would absolutely look at it. We want to just look back and see, we'll ask questions is what we do. What kind of rents have you pulled? How have things been during the pandemic? Have you been able to rent it out? Have you not been able to rent it out? So on and so forth. And that really, it's understanding the story and the asset and how it's survived. That's kind of how we position ourselves to whether we decide to do it or not. It's a little bit more of a deeper underwrite than maybe your traditional, family that's renting a home, because it's not that stable monthly income that's coming in. Rather, that they're living in it, right? They're making their payments monthly. You don't have to worry about the seasonality of it because that monthly rent's there. Whereas a vacation rental is a little bit different in the fact that you have to stress a little bit about, are people going to want to rent it out? Can our guy survive 3 months without rent? Does he have the liquidity to do it? And you start to look through things like that to assess the product and ultimately what can come about.
That's interesting. Like, this just came to my head, but for example, my father he owns a house in Palm Beach Gardens. I don't know if, because there's a country club, if they allow, no, they do allow, because he rents his house out. It's unbelievable. He'll get like 10 grand a month for like,
it's crazy,
3 or 4 months.
The upside of renting it out on a short-term basis is phenomenal. The upside is incredibly there. You have to be a good operator to do it, is the one thing I would caveat to people out there.
You guys would be interested.
Yes. But what I'm saying is to the investors that might be listening in is, you can't go buy an Airbnb property and expect for it to magically work itself. You got to have people that can go in and maintain that property.
But this is not, I'm not talking about Airbnb. I'm talking about just.
Sure, the seasonality of something like this. We would look at it. Yeah. Again, we try to use a common sense approach. And if the deal makes sense and the asset is a qualified asset that is, income generating and quality, and we feel good about the sponsor backing the loan, that's absolutely something that we would look at, right? I think the thing that is so unique about private lending is this conversation right here, the common sense approach, right? If we can develop that common sense approach to where we can look at the guarantor, the borrower on the deal, and we know that they can handle that property, and we can see that property is a successful property, whether it's a rehab project that's going to make money or whether it's a rental property that's going to be income generating. If we can formulate that story and we can put together a successful, all-encompassing deal as a private lender, and the same goes for our kind and Levine Capital, everybody, right? It's when you can formulate that story and see that amount of flexibility, we are there to create things to help allow you to scale your business based on the flexibility that we have to offer. So when you think of what we can do, it's all about that common sense approach, right? If you can create that common sense approach to a deal, I think you can get that deal done within this industry in a lot of different ways. And that's the way we try to approach things. Is we look at it there are things that we look at on a scalable level that we have set parameters on. And then there are certain things that we look at. Airbnb is a great example. You kind of got to look at it on a one-by-one basis to understand it, right? Multifamily, mixed-use commercial properties. I think those are a great example where, you got your scalable guidelines and your criteria, but every property is very different when you start getting into commercial, right? I mean, there's a lot of different, factors that come into play. And it's not that we're looking at it to say no, rather we're just diving into it deeper to make sure that we know that you know what you're getting yourself into and that we can understand that asset's going to be a successful asset.
Yeah. Another thing is what's interesting. My father, he owns a house in Colts Neck, New Jersey. It's like 7,000 square feet. And the craziest thing happened was he had on the market to sell it, but he wanted his number and he wasn't getting offers what he wanted, so he's renting it out. And what's interesting is I think it was like $8,000 a month, split up between 3 or 4 people.
It's crazy.
Yeah. So the question is with that. I mean, this is it's a big house. This is a new rental. I mean, who would have thought you could rent out a big mansion like that?
Yeah, I mean, it's when you get to large scale properties like that, it gets tricky. I'll be honest. I mean, it's when you get to larger valued homes, being able to craft that successful story is a lot harder than a traditional $200,000 to $250,000 property, right? But again, that goes back to, because if you think about standard, workforce housing, more traditional, property values, if I'm ranging somewhere between $250,000 to $500,000, it doesn't take as much cash flow to make that a successful property. If I'm talking about $1 million property, a $2 million property, some very large scale luxury housing, it takes a different business model, a different level of income to make that work. And that's not to say that it can't work, but the stories are tougher to craft on something like that as compared to a traditional home that you can rent out to a traditional family that pays a traditional rent. That works very consistently, right? $1 million property, you might need to rent that thing out at pretty high levels to, I think one of the unique things we see a lot of is we see a lot of high quality properties, mansions and compounds, right? I mean, some crazy properties around the U.S. that are just insane to look at. It in Florida, go to Florida for an example, go to Miami, Florida, and look at properties in Miami. Look at, go online and look up Tiger Woods' home. Look up some of the athletes' home that exist out there and look at, what kind of person it would take to rent that out. We see stuff all the time that's multi-million-dollar homes and, it might be leased out for $20,000 a month. Yeah, and the question you ask is how, why, who is behind that? And for us, if we're looking at a deal, and if you're looking as an investor of what to invest in a piece of collateral, that property is very specifically catered to certain individuals, right? Not many people can afford $20,000 a month in rent. I certainly know I can't. You look through all that, and that's a specific, do you want to invest in an asset that is solely dependent on a professional athlete living in it? Because that's a very well-defined marketplace, right? Do you want to, rely on something like that? Or do you want to rely on something that has the opportunity for the entire American population to rent it out? That's a much more secure asset. So you just have to look at all those things. And when you're kind of looking at a deal holistically, you got to take every factor into account. And I think that's a great example of one.
So going back, what's really interesting, I'll get a little off topic with my father. What happened was there's these young kids, they're stars on TikTok.
Yeah.
They're made a lot of money, but they use my father's house as a prop. It's they could take videos and they make it look like they're rich, famous, and it's all.
I know. I mean, that's a big thing nowadays, right? I mean, social media is kind of a wild phenomenon in and of itself, but people will rent homes out to go take pictures at the home.
Yeah,
it is. People will rent homes out for a day to host an event. There are a lot of crazy things that exist in the world today, and it's remarkable. Is really what it is. There's no other way around it. I know you're not going to find me renting a home out to go take pictures anytime soon. That's not my decision to make. That's the Beyonce's, but it's a unique environment.
They gave them a nice security deposit. He vetted them, and I think there's 3 or 4 people in there. But I think that I think that that's going to be a trend though, because this house, it's on like an acre or something of land. You have 5 bedrooms. So instead of living in like a little apartment, this is like, I guess it's a big house with 5 bedrooms. You got a finished basement, you got a gym, you got everything there.
Sure.
And it's
yeah, it's unique. I think one of the things that are a struggle in the industry, and it hasn't quite. I don't think we'll really see much stabilization in it, is single room occupancy, which a home like that might quantify as, which is multiple families renting out different pieces of the home,
that's it.
Units, and that's a struggle right now in the industry to get done and get done correctly, and it's because it's so hard to manage. Is the reality, right? I mean, it's just a much more difficult asset to take care of. But it's usually tied to a unique property, such as the one you're describing, which might not be as liquid as some would think.
It's not liquid to sell it.
Right.
Yeah, you're gonna. Yeah, I get it. But I know we're getting off a topic. So where are we now? We're at
yeah, we were talking through opportunities. You know, I think we've talked through a lot of the products that exist to, touch on those opportunities, right? I mean, when you think about all the opportunities in private lending to help scale business, you've got ground up construction, going to buy land and constructing a property, and a lot of infill. Infill is the name of the game, right? Is going to find a property that's in a liquid market and consistent with its surrounding areas. That's a great opportunity that our space can offer up, right? You've got renovation properties that we've talked about tonight, where you might want to go just do a little bit of a touch up or add a bedroom or do things like that to add value to the home. You've got rental products, these 30-year fixed rentals to rent your product or your home out and have a cash flowing property that's appreciating at the same time, a win-win. Portfolio options, which are hybrid alternatives to consolidate a number of assets into one loan, and maybe have an interest-only component to it. Maybe have a different term other than 30 years tied to it. Different optionality that exists to best service your needs. And then I think one of the biggest opportunities too, before we get to wrapping this up and touching on a few questions, is build to rent, which is a massive opportunity that we're seeing in the space right now. As people are looking, when you look at the dynamics of the industry, as home price appreciation, as good as it is, one of the things that it's caused a struggle for is fix and flip. That value add is tough to go find now compared to where it was 3 years ago, because home prices are so much higher. So it's tough for you to get, you used to be able to get 40% returns 2 to 3 years ago because home prices were down a little bit. Now they've gone up so much over the years that your returns might be 10 to 15%. So now you got to start out figuring out where to find value. That's in ground up construction. That's building to rent to then eventually sell to get that value, right? There's alternatives that we're continuing to develop in the space, and it's driven by capital that's inflowing to create different ways to adapt to the ever-evolving market that we're in and be able to service clients in the way that they want to be serviced, to give them the best, opportunities for success.
Yeah, and I see a whole bunch. I just saw an article today, Lennar Builder. They create a whole division. It's like Lennar single family homes. They're doing build to rent, and and I see a lot of apartment developers coming into this space, go into the build for rent. And I would love to hear how you could touch on like the benefits of that, because
I think we're going to see it on a lot of different scales. Is how to set the standard, right? You're going to have investors who are doing it on one-off basis, and they're going to neighborhoods and maybe taking a home and tearing it down and rebuilding a new one that conforms to the neighborhood. And that's a unique opportunity where I think there's going to be just a significant amount of opportunity, right? I mean, you build a new home in a market where home prices have appreciated, as long as you can control your construction costs, which is crucial. And that's a high price point right now, which makes this a difficult product of entry when you look at construction homes. But as long as you can control your cost, there's a ton of opportunity in that area, right? And you've got lenders that are going to be able to guide you along the way provides you funds for those renovations, those construction draws to help you get to that finished product. That's kind of part one of what I expect to see. Part two is the more institutional, wider scale. These companies that have a large amount of capital, a large amount of scalability, if you will, to be able to go out and take a piece of land, a large piece of land, and develop a community, develop a number of homes all at once. Maybe it's 10 homes, 15 homes, 20 homes, and develop suburbs that way. And you're going to see a little bit of both throughout the year start to come about. I think there's a significant amount of opportunity in the former, which is going to areas and finding tear down opportunities to build a home. If you think about construction, it's usually like if I have an opportunity to go do one of two things, I can go tear a home and rebuild it from the ground up, or I can go take a home and try to renovate it on a heavy, rehab level and find value that way. I really believe that the ground up is a safer alternative. And the reason I say that is because you might go into a project and want to do a lot of heavy rehab to it, and you could rip the cabinets off the wall, and all of a sudden you see that you've got mold.
You find surprises.
You find a surprise that's going to completely throw your project in disarray, and that doesn't mean you might not be prepared for it, but experience goes a long way in understanding how to manage that. Whereas a ground up, there are no surprises. As long as you have your permits in place, everything's approved, all the things are there, entitlements are there, so on and so forth, you're just constructing a home. And there are plenty of construction companies out there that can throw a home up very, very quickly. And there's no surprises. They're not finding things along the way. Rather, they know what they're doing. They have the experience. And I think that's a huge thing is understanding the general contractor that's behind these deals. That's going to be crucial in the success of these programs going forward. But you don't have those same risks associated with a renovation deal. So I think as we start to see more volume come about throughout the course of the year and into next year, you're going to see a lot of people realize that. And you're going to see a lot of people understand that this is a pretty straightforward model as long as you have a general contractor who knows what they're doing. And it's going, as long as you're doing it in areas where, you're not overbuilding, you're building conforming houses, which I think is so important. If you're going and building a $500,000 house in a neighborhood filled with $250,000 homes, you're not going to find success. It's not going to happen. You want to go build a $250,000 home in the $250,000 home neighborhood, right? If all my homes are 2,000 square feet, my 5,000 square foot new build is going to struggle. If I have it as a 2,000 square foot new build, that's going to have success. Those are the things that you're going to see as the trends and the dynamics that allow for a successful product line and development throughout the course of the year.
Yeah, it makes sense. And another thing that I wanted to touch on is what's interesting is the build for rent, right? You could take on debt literally to build communities. And what's interesting is with apartment building, you got to finish it to rent it out.
Right.
But with single family homes, you can start building and renting and start cash flowing.
You nailed it. And you can cash flow by renting it out. You can cash flow by selling it.
Yeah.
And the amount of, you make a great point. Whereas if somebody goes out and they want to do that 20 unit property because they see the big dollar signs associated with it, it's timely. It takes time to rent those out. It takes time to get it cash flowing. It takes time to finish those projects. But if you're doing exactly what you're describing, this build to rent model, if I'm going out and I'm building 10 single family homes, when number one is done, while I'm working on number two, I can get number one cash flowing, whether it's selling the property or renting it out. And you can continue doing that as you continue to add more and more homes. And it all goes back to that scalability that we talked about, which is if you find a good partner to work with and you find somebody to work with that is able to guide you through that process and give you that functionality and that ability, I think it goes a really, really long way to start slow and build up and understand and learn from your mistakes and scale your business that way. I think you nailed it.
Yeah, and another thing is for the larger guys out there, what's really interesting is there's buyers for these portfolios. So really when people, let's say apartment building, right? You buy, you build, you sell, right?
Right.
We actually invest with some developers that do that. But now the same thing could happen with communities. These single-family home communities, the same thing. You buy, you build, and you have an end buyer that would just buy the whole community from you.
Right.
And it's amazing that it's out.
It's amazing. And it's amazing to see, when you think about, again, going back to the beginning of tonight's, session, when you go back to 2010 and you think about where things were and where we are today in this marketplace, it blows you away to be able to go back there and see how, we joked about it yesterday when we were talking as a group here. It was hard money, then it was soft money. Now it's sophisticated money, right? And you see this amazing organization to the industry that is pretty surreal. And you're not only seeing that in prices and parameters like that, but you're seeing it in products, you're seeing it in opportunities. And what we're trying to do is provide a liquidity source to help borrowers and investors go out there into the world and take advantage of what is, in my opinion, and many others, the most secure asset in the world to invest in. And it's an amazing concept that we've been able to get to where we are today and offer the abilities that we're able to offer.
Yeah, so this is a question. I know that someone asked this, and actually I'm curious too. I kind of understand it, but I'd like to hear it from you. So let's say the advantages of like you have an apartment building, and you have, let's say, 10 single family houses. You got a 10 unit, you got, right? Now, with an apartment building, you have two exit strategies. Well, one, really, a full out sale, or you can refinance. You have two capital or sale. Let's say 10 single family homes, look at, like, for example, look at what Invitation Homes is doing, right? They're doing seller financing, right? So you could actually, you can't just sell bits and pieces of an apartment unless you go through a condo conversion, which,
right.
But you could like 10 single family homes, you could sell off onesies or two and still keep a portfolio. So you actually have more flexibility with this.
Yeah, you do. I mean, you're exactly right. And I would, it's flexibility in terms of what you can do with the assets that you have. But there is an ease of use that's associated with it as well. There is a different tenant and there is a different renter on a single family home than there is an apartment. Two completely different renters. And that's two different pieces of clientele that you've got to manage. And with single family aggregating it in multiple properties, you're able to establish that level of flexibility and understanding and that certainty, if you will. And you're able to do it in a way that doesn't require the amount of, if you think about a 10 unit, you got to make sure you've got amenities to bring people to that apartment. You've got to make sure that you've got somebody that can manage it, manage a different style of tenant. If you've got vacancies, you've got to go out and market that, right? You've got to do a lot of different things that go in from a CapEx perspective or capital expenditures to make that deal work, right? I mean, it's very rare you're going to find a 10-unit apartment and just be able to magically rent out all 10 units 100% of the time and not have to put in any work. That's not going to happen. That's just not reality in the U.S. But you don't necessarily have to go through all those, hurdles with a single family home, which allows for a little bit more ease of use and flexibility. Now, that being said, I think there's a tremendous amount of opportunity for multifamily. Don't get me wrong. I think there are plenty of opportunities throughout the nation of areas that make sense. I think that there's a little bit of a more stringent focus.
I think maybe more small multifamily.
Yeah, I think that's exactly right. I mean, I don't want to go do a 50 unit in Manhattan or New York, right? Because that's a tough one to get behind right now. I don't want to necessarily do a commercial focused product in areas where people are fleeing. I don't necessarily want to do that. I want to take a look. Commercial's an asset that's struggling right now. So if I'm doing a mixed use property, I want to make sure that there's a residential component that works to a large degree, right? I don't necessarily want to lean on the commercial component because right now it's not working. And I would agree with you. Are there deals that are high unit counts that work? Yes, absolutely. There's a very certain type of investor that can handle that though. And I think that's the difference. And when you look at that chart that we showed earlier, that's not only showing the level of investment properties, on a percentage basis across the country, but that's a great explanation to the kind of people that are out there to handle a multifamily project.
Mm-hmm.
There's a much larger population of people that can handle a 5 to call it 25 unit property as compared to those that can handle a 25 to 50, that can handle a 50 to 100. And you just introduce so many more dynamics as you enter those more higher unit count situations that require a different operator. And it's not to say nobody can do it. And it's not to say that we don't like the asset class, because we do when it makes sense and we feel comfortable with, the person going into the asset. We want to make sure that they have the capability to do it, to be able to handle it. And that's where things get a little bit tricky, because as an operator, myself, I could not go buy a 20 unit multifamily property and confidently say today that I could handle it. But I could go out and buy a couple SFRs and confidently say that I could handle it. And there is if I'm a lender or I'm a pool of capital, I know that. I know that about me already. I know that based on what I'm able to show from experience and from myself, that it's going to be tough for me to manage that property. So you might have some questions asked about, who's my property manager? How are you going to handle this, that, and another? What's your experience look like? And it causes that little bit of questioning. But if I have, a couple, 15 unit properties under my belt, and I bring you a 20 unit property, that I'm going to be able to handle that because I can show you that I can handle it, right? But that's a different kind of investor compared to, Joe Smith, who's investing in, traditional SFRs. So it's not a matter of not enjoying or loving the asset class. Rather, it's making sure that you know how to handle the asset class.
Yeah.
And I think what we're getting in this conversation is the majority of investors out there, when you look at that chart earlier, 85% or more don't have anything above 10 units, right? So when you look at the 85% of a $4 trillion rental industry, and you look at that marketplace as a whole, that is going to focus more on single asset 1 to 4s. That's how you're going to scale. That's how you're going to do it right. And then as you continue to get that under your belt, if I've got 5 SFRs under my belt and I want to go buy a 10 unit, I've got that experience now to be able to understand what goes into it. Maybe not quite, because there's going to be nuances to multifamily that pop up that I don't deal with on a single family home, but at least now I know how to manage properties so I can manage that one a little bit better.
There's also a few other factors I've been reading and hearing, is that generally the larger scale owners, they're much more well capitalized than the mom and pop investors that are dealing with the small multi. And
you're exactly right.
That's true. Probably if you're an investor looking for opportunities, because trust me, I was trying to look for large multifamily and sellers weren't budging. I was not looking to pay pre-COVID pricing. Again, people are paying pre-COVID pricing. It's unbelievable.
I get it. I'm right there with you.
It's a whole other topic we could get into.
Yeah. I'd like to say a really big thank you to all the folks who are still staying with us. We do appreciate your interest and stamina. So I see a whole bunch of questions coming in from the audience. So if you have any question on your mind, please get that into the queue. So the question here is, there's a capital market stigma against ground up construction and its risk profile, i.e. low severity when it defaults mid-build. Do you see that changing as heavy rehab deals over time have shown they're just as if not riskier?
Yes is the answer. And, I appreciate that question. It's a great question. It's been one of the hurdles for the industry for a while is, when we talk about capital markets throughout this call, there has been a preference for fix and flip deals. There's been a preference for stabilized rental deals. There has not necessarily been the large appetite for certain types of deals, build to rent being one. There's a very unique pool of capital out there that's okay with portfolio loans. And ground up construction is a great example of one of those things. And there has been a stigma against it. And it's always been a conundrum to me. I don't know how else to say it, because when you look at heavier rehab deals, and that's a great point that's made in the question, as time has progressed and we've seen the performance of this asset over time, I think what people are starting to realize, and it was what we just referenced a little bit ago, is The heavier rehab projects, the value adds that are of significance, maybe you're adding a bunch to the home, you're doing a lot of interior tear down and rebuilding. There is a ton of risk that can be attached to that. So the big thing for me that's really developed, and I think you're going to see a little bit of a pop in this in 2021 as it pertains to ground up, is there is a massive focus on a couple of things. One is getting an understanding of entitlements, plans, and permits. You want to make sure that the city, the municipality that you're working in has the capability to approve what you're trying to do. Because if they don't, the project goes nowhere. And I think that's one of the big red flags that people have had to keep an eye on and fully understand and how to work and structure. The other is understanding your general contractor and how to control the process, right? You don't want to, as a lender, start lending a bunch of money in renovation draws to find out that permits weren't approved and the house is illegally built, right? That's a bad situation for people to be in. So I think what it's getting to is going back to that concept we were talking about earlier of it just needs to start. It just needs to get going and get volume under its belt and start to see some things. And that stigma is going to go away when people start to realize, once we understand how to make sure some of those major concerns are taken care of, making sure that we've got legal zones, we've got entitlements in place, we have a general contractor that's been vetted and looks like they can manage this project. Once those kind of big ticket items are understood on a scalable level, I think we're going to start seeing a lot more capital flow in to really get behind conforming infill projects. It's going to take some time for the larger scale projects where it's, going and buying a piece of land and doing 20 builds. Where I think we're going to see the immediate inflow, though, is really that single property infill style of project.
So you're saying basically there is capital for the infill build a tract of houses. I'm seeing, these are larger operators with certain lenders, but that's only as a small amount of capital.
It's to the point of where I don't even know if it's necessarily useful for this call small. It's a very unique a very unique operator that's doing those types of projects. And usually the capital is not aligned with what we're talking about on this call. It's a very, the capital they're getting is capital of private money that's invested within the operator itself that's allowing to go out there and do it. And they might be financing through banking institutions to throw leverage on those deals and work their capital a little bit better. But it's not similar to, the securitization and the whole loan sales and kind of what's available to us in the industry today from our points of view, if you will.
Got it. That makes sense.
But where it is available and where you're going to see that opportunity is on the smaller scale, infill projects that are single property, so on and so forth.
That makes sense. Yeah. No, this is really good to know. I agree 100% that ground up is the riskiest. Opportunistic is the riskiest strategy, or one of the riskiest. But
that's the stigma.
Yeah.
But I don't necessarily believe that's the case, and I think we're going to see a pivot throughout the course of the year in a change in philosophy. But it takes somebody. It goes back to COVID. It takes somebody getting things going again, and once you get that going again, and we start getting some repetitions under our belt, and we start to learn a little bit more, I think we'll see a little bit more capital inflow. But to the question's point, there is a limitation that exists in the space today, and there's very few that have accessibility to the capital. And when we start seeing that develop on a wide scale, is later this year, in my opinion.
For you guys especially, you'll get back into that.
Yeah, I mean, we are to a certain degree. We're definitely getting ready to go through a new relaunch here in the next couple of weeks, candidly. So, that's news to everybody there. But we pulled back. We've been trying to get back into it, and we plan to do that next month. And we'll do it with a large scale behind us. But we're on the larger scale, and we have a little bit of a larger production, which I think gives us the capability to do that. when we talk about the capital sources for the very local lenders that exist out in the world today that operate in their own industry, and they have a little bit more of a limitation to the capital sources available, that's where I think it's going to be a little bit down the road, because I think these capital providers out there need to get more of a touch point and sensibility towards the product itself with operators that have a large scale, operation that can handle it, to then be able to start rolling that out nationwide on a more scalable level, if that makes sense.
No, it does make a lot of sense. Okay. Any other questions, Tay? I know your mom.
The more questions here. So do you see a trend where capital and banks are entering our space, enticing lenders to hold more of their risk at better yield versus selling whole loans? Some banks are the borrowing bases are the same size in outstanding as whole loan aggregator portfolios today.
Yeah, so it's an interesting question, and I think I get what it's. I think I get what it's ultimately trying to get at, which is when you look at some of the whole loan sale opportunities as lenders today, there's a participation opportunity that exists. So as a lender, if you want to sell a loan, you have a couple different options. You can sell the loan at whole and wipe your hands clean and move on, or you can sell and participate still in that loan. And Adam, you were kind of alluding to that earlier today, where I might maintain a position in the loan itself, and that might result in a better price point from a lender perspective and how they're selling. So, for example, if I sell a loan in whole to somebody at 7%, if I sell that same loan to them and say, hey, I want to hold a 5% interest in the loan as a way to show that we still have interest as well, they might give you 6.75 instead of 7, or 6.5 instead of 7, and it allows for a different, a level of interest. It again really just comes down to the operator themselves.
Okay. I'm just reading the questions. Wow, we've been on here for a while. I just
realized it was 10:15.
You know what it is? It's like when you really have a passion for something, you just flow. You just don't.
Yeah, it just goes on and on and on.
Yeah.
I'm with you there. I mean, if we're not careful, we could go on for days talking about
something. I just go on and just talk. And no, this is really interesting stuff. We're about to wrap it up. So if anybody has questions, if we don't get to them, we'll be happy to.
Yeah, I'd love to. If there's questions that are in the panel, if we want, I'd love to get a recap later, and we can respond to them, or reach out via email, or whatever the case might be. We're happy to discuss. I'm certainly happy to address anything in there and provide any intel. But Adam, before I let you and Tay wrap it up, thank you for bringing me on tonight. It's been great to chat with you guys and to talk through some of this stuff. I certainly love to speak my mind on the space and my point of view on where it is. But it's exciting times for us, and there's just no other way to sugarcoat it. And 2021 is going to be a fun year. I'm looking forward to what's to come. How things are going to progress and operate throughout the course of the year is going to be magnificent. But thank you for bringing me on. It's been a pleasure to talk with you guys and kind of pick each other's minds a little bit about what's going on out there today.
Yeah, 100%. Thank you again. And I know you're a golfer, so I'm thinking I want to take a trip. I want to get back into golf.
Whenever you're ready. I'm ready to get out there and go.
Yeah, I'm ready too. I'm not good.
It's all about having a cold beer on the course and enjoying the camaraderie of each other, right? That's
exactly. But yeah, same thing. Likewise, I really appreciate you coming on here. Someone with your level of knowledge, it really means a lot, because there's so much information out there, and just to get it from the source, someone that deals in the trenches, this is this is a really great.
We're all in it together to accomplish the same goal, which is, every piece of the puzzle wants to make money, and working together to accomplish that is what makes such a successful marketplace. And that's where we are today. And it's a fun thing to be a part of.
Yeah. So what we'll do is we'll wrap this up now, and we'll address questions in the email, and we could also send out a replay of this video as well. It will be it's recorded, and you could we could distribute that, and I'm sure people will probably want to go back and listen. I'm certainly going to go back and want but it's 10 o'clock p.m. Eastern Standard Time. I'm about to get ready for bed soon.
I'm right there with you.
Yeah, I'd like to
on the hour here.
One message from the audience. For what it's worth, can we do a part 2 with Justin Parker soon? Very enlightening.
Absolutely.
Let's get it on the books.
Yeah, let's do it.
I love it. Well, guys, look, thank you so much. Thank you to the audience and the interaction. It's certainly been great. I'm looking forward to answering any remaining questions. Probably tomorrow. I don't know if I'll be able to get to it tonight, but what a wonderful time it's been with you guys tonight.
Thank you everybody for joining. Thank you for the questions, and we'll let's keep in touch, and feel free to reach out to us. We're here. So
absolutely. Thanks, everyone.
All right, take care, everyone. Bye.
Take care. Yeah.